will not go into recession. There will be a slowdown. But, you know, labour markets are so tight. Right. We have fiscal levers, and, you know, some of the rules around the Stability and Growth Pact relaxation are being extended. So I don't think we're facing it into recession. Not as rapid growth as we might have hoped for, certainly. But, you know, who knows, and we can't take that for granted.
We have no time left. All I'm begging you is get more flights into Dublin, because the taxes at Heathrow are outrageous. Outrageous. We need more flights on Air Lingus.
Way to be on the serious issues, Tom. Thank you.
We have no travel tax.
No travel tax. There it is, folks. Your message.
We're an island and we want you to come, so please
we
do.
will continue. As Leo Varadkar, of course, the former Prime Minister of Ireland and now Irish Trade Minister. Please stay with us from Davos, with markets churning Snap down near 30%. What is Snap?
It's a social media company.
Oh, thank you.
Keeping you up to date with news from around the world with the first word, I'm Rishika Gupta. ECB President Christine Lagarde says the central bank won't be rushed into withdrawing monetary stimulus whilst it fights inflation. Lagarde spoke to Bloomberg in an exclusive interview in Davos. She said there's no need to panic. Bank of France Governor Francois Villeroy de Gallo echoed Lagarde to insist there is no consensus for a half-point interest rate hike. Kansas City Fed President Esther George expects the central bank to raise interest rates to 2% by August. After that, she says more tightening will be guided by how fast inflation cools off. George has been known as a longtime policy hawk who more recently moved to the center. And JP Morgan Chase and UBS have downgraded their forecast for China's economic growth this year. Both cited the impact of Beijing's tough COVID-0 restrictions. UBS cut its forecast from 4.2% to 3%. JP Morgan reduces its estimate for China's growth from 4.3% to 3.7%. Russia's war against Ukraine has made a global food crisis worse, but Moscow is amongst the biggest winners of the mess it helped create. The war has blocked Ukraine's grain exports by sea, helping send wheat prices to near record highs. Meanwhile, Russia keeps shipping its wheat at the higher price. Bloomberg's learned that Dexcom is in talks to buy Insulet in a deal that would create a giant in diabetes devices. An agreement could be reached in the coming weeks. Insulet had a market cap of $16.1 billion at Monday's close. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes, have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
With respect to the tariffs, our approach, as with everything in this relationship, is to be strategic. We have to keep our eye on the ball in terms of how to effectively realign the U.S.-China trade and economic relationship.
By near universal acclaim, Republicans and Democrats, the acclaimed Catherine Tai, U.S. Trade Representative, she's doing a great job with a really interesting political soup. And to be honest here, Lisa Abramowitz, this is important. At this meeting, there's an understanding of Davos, the elites, globalization, and the Republicans and the Democrats don't agree with the trade representative, do they?
Well, right now, the trade representative is actually sounding a different note than even President Biden when it comes to lifting some of the tariffs on China. There is so much concern around how to cater to both the globalized kind of elite, you can call them. A lot of it is mainstream economics, and the populist upswing of both parties, both Democrat and Republican, that politicians are trying to cater to.
We will see. The helicopter you hear is filming of the Abramowitz story. They're filming it up Happy Valley this week, and they're doing daily shooting as well.
You'll have to tell me about that story.
I'll tell you about that. Well, no, you got to. That was last night. Welcome to the meetings of the World Economic Forum, but we are paying attention to the markets, and we do that now with Anthony Dwyer, Chief Market Strategist at Canaccord Genuity, and he, more than anyone we speak to, has linked a bullish tone to the market and optimism with recession as signal. Tony, wonderful to catch up with you today. Are we finally at a point where Dwyer goes bearish because of the dreaded R word?
No. I've been coming into this year, I was neutral, Tom. We took a neutral stance. Really, it's been a while since I've kind of been, quote unquote, the biggest bull. And the reason is because it's all about the money. You had a crazy move higher last year in a lot of the stocks that are now under the most pain. But ultimately, we came into the year expecting a tumultuous year, which, as you know, is a good word for me, multi-syllables. We came into the year looking for a tumultuous year because you had this monetary transition. When they made that hawkish pivot in December, they made a case that they were going to raise rates, and they keep making that case. And until they stop making that case, which means inflation has to come down, it's going to be one of those, it's going to be a pretty difficult environment. Now, you can have a bottom, like I think we're close to, where you can have a pretty good bounce, continuing on with what's happened over the last couple of days, maybe into early summer, and I've got a couple of years that are very similar to this that we could talk about.
Well, Tony, have we seen capitulation? You say we're close to a bottom, of sorts. Define that bottom at a time when most people do not see capitulation yet.
So if you remember in 1994, Alan Greenspan was a lot tougher than anybody thought he would be. And that capitulation didn't come until the end of the year. You had the early year whoosh on a Fed that was really a lot more aggressive than anybody thought. You could have made the same case in 2000 or 2018. So in the beginning of the year, you get this Fed-induced whoosh that kind of peters out. It becomes extreme. And we've seen that. You have extreme pessimism and oversold indicators. So what you get is a summertime bounce. And I think, Lisa, that's kind of what we're embarking on, is that bounce back that can recoup some of the losses. But then you get the economic reality of what happens in a leveraged system when the Fed is super aggressive. And that means at least we should have, quote unquote, the fall. And from there, it's going to depend on monetary policy.
So before we get to the fall, I want to talk about Snap. Some people might come in and say it doesn't really matter. It's just one stock, with the CEO coming out and saying that the forward projection is going to be lower than the lowest estimates. Right. Other people might say this is indicative of an economy moving faster than even the CEOs understand. How do you read this?
Okay, so you asked the perfect question. Sorry, Tom.
I never do.
So here's the situation. 2 weeks ago, Neil Kashkari said, and I quote, "We have removed, based on the way that mortgage rates have gone from 3 to 5 1/4, we've removed accommodation faster than we gave it in 2020. Think about that statement. Trillions of dollars. So then you add to that the most recent consumer confidence CEO survey. It got hit more than on a year-over-year basis than I can find any hit in history of the data survey going back to the late 1970s. And the University of Michigan data is as pessimistic as it's ever been. So somebody better tell everybody that's talking about a good economy, solid employment, good funds in the bank. Somebody better tell the CEOs and the individual investor, because they're not seeing it.
Right. Tony, I talked to Michael Dell at length this morning, all off the record, of course, and here's a guy that came out of a dorm room and amended Dell computer 14 times. That's a suppleness that's part of the optimism of technology. Are you optimistic that the acclaimed FANG stocks can adapt and adjust to the new financial system, the new monetary system that's been given to us?
Okay, Tom, so I used tumultuous multi-syllables. Here's another one, differentiation. It's going to be on how companies manage through a slower macro backdrop. I thought the interesting thing out of and I can't comment to Snap's earnings or anything like it, but I thought the interesting comment was how the macro backdrop was worse. Right, and that's what these CEOs are going to have to deal with. But we're in a leveraged system with excessive debt and technological advancement. Remember, technology only improves itself exponentially with speed. So it's not like the Industrial Revolution. It keeps getting faster and it keeps getting better, and new technologies come out. So those forces are still with us longer term. We happen to be in a very bad inflation situation that puts the Fed in a box where they have to maintain this higher interest rate environment even as the economy slows.
Tony, thank you so much. Greatly appreciate it. With Canaccord Genuity this morning here on the outlook of the market. And Lisa, I just got handed me, Amy saved me here. I thought Snap was Snap-on Tools. You know,
when have you ever used Snap-on tools?
In my vast, look, you put a hammer in my hand, people run.
I know, exactly. That's my point. Maybe you want to snap them to the wall and hope they stay there.
Seriously, what is Snap? I honestly don't know what Snap is.
It is a social media company with Snapchat. Your daughter doesn't use Snapchat?
No.
Come on. She does. She just doesn't tell you. There are a lot of social media companies. The big takeaway for me is the differentiation, if we want to use that multisyllabic word, within big tech, right? And this is something Dan Ives was talking about extensively. You have the hardware providers, the Apples of the world, and then you have the very economically sensitive, advertising-driven types of models like Snap, and you start hearing about not only is it demand affected, but if companies don't have the goods to sell, why are they going to advertise all that much with a lot of these social media providers?
Gentlemen, we're going to speak to scheduled later today. Brian Moynihan of Bank of America, thrilled to bring you that conversation in a number of hours. in his busy day. And what I think Mr. Moynihan would suggest is the real technology forward for technology companies is free cash flow.
Yeah,
and a lot of them don't have free cash flow.
And the ones that do are buying back shares and giving a lot of bonuses to their employees, because right now, other than acquisitions, where do you invest and how do you invest? You know, Morgan Stanley put out a survey. They did a survey of consumers in the United States, and it showed that more than half were very concerned about inflation as their foremost concern, and that more than half were planning on cutting back purchases, particularly discretionary purchases.
That's the gloom we need. The cloud, the toxic brew of gloom descends here at Davos.
It's cloudy today. See?
With Bramo. It's a fog. The fog here, for those of you on radio, the fog is set in. Oh, wait, that was my questions. What did he say? You had a perfect question?
Oh, I don't know. You did too, Tom.
Where's Pharaoh? Where is Pharaoh? Bob Prince, next. Good morning.
The end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali, sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan, bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu, sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
We're in this new normal where inflation
is much higher than anyone expected.
This inflation is going to be pretty persistent, not where it is now, but way above where the Fed wants it to be.
The market has raced ahead of the Fed, anticipating the Fed to be very aggressive in their action.
The Fed's not going to back away because the market's tough. The Fed's going to back away because inflation starts to slow later in the year.
Raising interest rates is not going to solve the problem of inflation.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Today from the World Economic Forum, day 2 in Davos, Switzerland. Extraordinary and interesting meetings, more different than anything I've seen in whatever it is, 18 or 19 years. In May was the meeting scheduled in January. Lisa, I was speaking to WEF officials today, and they don't want to say yet formally we're on for January, but they're really getting there quickly.
Well, there's the difference right now between very nice weather that people don't want to miss and the fact that people are enjoying the fact that it's not snowy and icy, to the fact that in January, people are getting the agenda done, and it tends to be more crowded. So how do you parse that out? But this is a moment where people are coming together amid a sea of uncertainty for off-the-record conversations about how things really are, because they cannot say it in public.
Market stable 2 days in a row, up and down fractionally, I'll say, without the emotion. Can you imagine what these meetings would be like if what we've seen the last 2 or 3 weeks had continued?
Yeah, then it would be absolutely a little bit more fear, although a lot of people look at this as a short-term reprieve, and that's sort of what we were hearing just now from Tony Dwyer, that basically there is this feeling we've baked in a lot of Fed tightening, there's a pause, and suddenly people are reassessing to figure out where we go from here.
But the tea leaf is $1, and Lagarde said that to, Christine Lagarde said that to President Lacroix as well. There's some adjustment here.
Yeah.
Maybe it's her jawboning, maybe it's James Dimon, but Euro stronger is a breath of fresh air.
And it's because Christine Lagarde has asserted that they are going to move to avoid the negative yielding policy, or the negative rate policy, I should say, by the end of September. But it's paired with Raphael Bostic of the Atlanta Fed coming out over the past 24 hours and saying he views September as a good time to pause with rate hikes and to reassess.
Thank you.
So how much are we really pricing in a pause from the Federal Reserve?
Okay, this is, folks, I miss stuff up here. I'm sorry, it's a shock, I know. I miss this from Mr. Bostic, who's very measured in his language, but that goes to the sequential meetings. It's nonlinear. They do some easy lifting in June, and then it gets to be sport out to September.
Which, if that's the case, then it feeds into the bull case that this Fed will not be as aggressive as the market is currently pricing in. Right now, I got to say, in markets, yes, we are seeing a churn, but yesterday we saw a bit of a reprieve. Today, not so much. And we're seeing back to what we saw over the past 7 weeks, with 7 weeks, the longest stretch of losses going back to 2001.
Let's look at the data and tell us about what we got going on here, Lisa.
Well, the S&P is down 1%. 39.31. The dollar strength does continue. Euro really, dollar weaker, euro stronger. 107. Thank you. I appreciate that. Yields up to yields down. Excuse me. 2.82%. A little lift to crude now, but honestly, what I really want to know is the people, the incredible guests we have coming up, including Bob Prince, co-chief investment officer at Bridgewater, who is going to be with us in just a couple of minutes. Pedro Sanchez, Prime Minister of Spain, and Tony Capuano, Chief Executive Officer of Marriott International. They've gotten really some of the biggest benefits from all of the consumer spending, as everybody has experiences. How long can that last, given some of the concern people have about inflation?
One thing on the Bloomberg screen today, it's beneath the radar. Mr. Erdogan is not at Davos today, but we did see Turkish lira break through. It's been sustaining stronger lira, relatively stronger, holding at 16. And dollar lira just a bit ago broke through decisively to 16.11. It's off the radar, but that's something I'm looking at. Part of Davos is the investment. People come here for years after years after years, and some of them have the means to invest in Happy Valley. And we're thrilled to show you something that Ray Dalio of Bridgewater has done. I mean, it's something when you're as large as Ray Dalio, and you can get a couple acres going, and you've got the Dalio goat farm. I mean, it's out there. And, you know, I said, who owns the goats? And they said, we're going to get a shot for you now. On radio, it is The Hills Are Alive with the Sound of Music. And it's the goats just behind us. We can hear them bleeding. They're saying, one of them said, cash is trash.
Yeah, cash is trash.
Anyways.
From the goats, the Dalio goats.
Well, I don't know if they're lambs or goats. It can be both. The lambs and the goats. Come on. Guys, this is the help we get from New York. They're saying, are they goats or lambs?
right, let's
thank you.
Bob
Good
Prince.
to know that from New York. Right now to save us is Robert Prince. Bob Prince is co-chief investment officer at Bridgewater Associates. You don't own any goats, do you?
No, but my grandchildren have 2 little sheep.
Okay.
They
well,
do,
we'll
right next door to us.
There's
Baby sheep.
Oh, the Dahlia Farm.
There's a surveillance break exclusive. I want to take a bigger picture Bridgewater having a much better year this year with some solid returns. The backdrop is a bond market that only people with the gray hair, you and I, have experienced. It is extraordinary. Price down, yield up. What are the ramifications if this bond bear market continues?
Well, I think the way you have to look at the bond market is that there are really 2 bond markets, according to what's priced in. There's the front end of the bond market, which is priced in a tightening. And then there's the back end of the bond market that's priced in that everything's going to be fine after that little tightening, and that the inflation rate's going to go back to 2.7. So the near term has been priced in along the lines of what you're saying, and that pricing has passed through to equities and other assets. But the second round of tightening hasn't been priced in. It hasn't been priced into the bond market. It hasn't been priced into the stock market. It hasn't been priced into break-even inflation. And so whether that's actually going to happen really depends on the underlying drivers of the inflation, which I think would be good to go into. But there's more to go, I think. Maybe in the near term we get a little pause because the Fed will probably follow the forward curve up. But even if they follow the forward curve up, you're looking at a bond market that has not discounted anything higher than 2.7.
This? You and I have never, 78, pre-Volcker, 77, 78. How do we recover from bond losses like that?
You got to hold something besides bonds.
Goats.
We'll get into commodities.
Or stocks, for that matter. I mean, you got to go to inflation assets. You got to go inflation index bonds would be better than nominal bonds.
Before we get into a number of the issues that you talked about, including the sources of inflation, which are key, I want to pick up on something that you were pointing out, the second round of tightening, because you can figure out what's going to happen with the Fed, but perhaps people are not getting the response in markets correctly. If the bull case, as people are laying it out, is that the Fed pulls back, is that actually a bullish indicator for equities, or will that actually be negative because it will only send long-end Treasury yields that much higher, priced down?
Yeah, the key determinant of this is the nature of the inflation that we have right now. We think of this as a monetary inflation. We think we're in a monetary inflation, which is a very different animal than what we've experienced in the last couple of decades. Recent inflation has a cyclical inflation is when you get a pop in the economy, pushes up against capacity constraints, inflation goes up. But money and credit are under control. This is a monetary inflation more like the 70s. It was triggered by the massive injection of money and credit by policy, which has now created a self-reinforcing process, very high levels of nominal spending, 10% nominal GDP growth. I mean, it's a long time since we've seen high nominal GDP growth, right? So there are things happening now that people are not used to because we haven't seen these dynamics for a long time. But the result of a monetary inflation is high nominal GDP growth, and then that gets absorbed by prices, and so you get low real growth.
Right.
And that produces stagflation, which creates a very difficult policy choice.
So do you think that the U.S. is facing stagflation?
We're headed toward it, yeah.
In the near term, in the next 12 months?
We're headed toward it.
I mean, you game out what that looks like. I mean,
we are, we're on the cusp of it, yeah. And it's how do you define stagflation? There'd be different ways, but basically the way we look at stagflation is in terms of how it affects markets. And the way it affects markets is if the inflation rate is higher than discounted and the growth rate is lower than discounted. And we're in a situation right now where there's a very low inflation rate discounted, therefore it's easy to be above that, and we've got a high growth rate discounted, therefore it's easy to be below that. So relative to what's discounted, we could very easily be into this very quickly.
I want you to talk about the volatility of hedge funds, where we're seeing people going out of business. Okay, fine, that's a different story. But we're seeing somebody get pounded one year, come back the next year, and that. Is the volatility that we're seeing in alternative investments, is that acceptable? Or does it have to be a new paradigm to something involving more stable returns year to year?
Well, you know, a lot of that comes from having a long bias, right? And so it really paid to be long for a long time.
Right.
And so that gets embedded into the psyche. It
Absolutely.
gets embedded, the money flows in that direction. Those are the high returners. And long with leverage is even worse. And so, you know, you see that kind of washout when you get a reversal.
How will macro do now? How do you do macro? In the algebraic equation of Davos, there's an epsilon off the back end you and I have never seen.
Well, macro's finally
macro?
interesting again.
Okay.
Right? I mean, last time we talked,
Every
it
time
was,
there's macro,
it was
Dalio sells 10 more books.
It was Dullsville, you know, in 2020. But no, thanks to
So
that,
what's your
thanks to
macro
all
bet
that
right
money
now?
creation,
Come on,
that inflation,
I gotta buy a
that
goat
bond
farm.
move, that tightening.
Congratulations.
This is interesting stuff.
Bob, what is the macro call right now for you and Mr. Dalio?
Well, our whole team, you know, we shouldn't just, you know,
Okay,
have it.
Patterson as well. Okay, move on. What's the macro call?
That the markets are under discounting the inflation picture. That the sustainability, the self-reinforcing of the inflation is not discounted. The degree of tightening over time is not discounted. And I think within the stock market, even different types of companies and how they benefit or are hurt by a high nominal GDP rising interest rate environment. It's a unique environment. You can't just take the average of the stock market.
Right.
You have to go inside it.
How much has leverage been beaten out of the system, and how much more is there to be unwound?
I mean, I would imagine there's a lot more to come out of it. It took a long time to build it up, right?
Traditional financial leverage, meaning that funds that could actually quickly have to unwind and forced selling that we have not seen to date.
I don't really know, but I would raise the opposite case as something that's important to register, which is the not leverage in the banking system. As we think about the economic environment and the impact of the tightening going forward, the banking system is not leveraged, high capital, very stable deposit base, and they have the most low risk asset portfolio in ages because all that printed money went to deposits and they bought treasury bonds, high rated mortgages, and cash. So the loans to deposit ratio is at a multi-decade low. So that even if the Fed tightens, the banking system can sustain the flow of credit into the economy, and household balance sheets are much better than they've been in decades.
Have you made a macro call in the Pennsylvania primaries? Are you doing that at Bridgewater? Is there a macro call there?
Counting, aren't they?
They're still counting. Very good. Bob Prince, thank you. So that's well, it's not an inside joke, but again, the politics of Bridgewater over to the politics of the great state of Pennsylvania. Bob Prince of Bridgewater with an annual visit. Thank you so much. Greatly
Good to see you.
Appreciate it. Lisa, why don't you tease the next guest, because he's so damn gloomy.
I know. I knew you were going to do this.
This is just, you know.
Yeah, he's coming up here in almost 45 minutes. Mike Wilson, Chief U.S. Equity Strategist at Morgan Stanley. He's gloomy, but he's been right. And I will say that has been very important. He has been right.
He's done a dovetailed off Zentner, who went from transitory quickly.
Yeah, and talking about how there's more re-rating to go, actually looking at a 3,200 on the S&P as a possible real case, honestly.
Welcome all of you here. The meeting's the World Economic Forum in Davos, and we will continue. Futures negative. Good morning.
Companies know they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
States, it's much more about rates because there's more resiliency in the economy, in the labor market, in the consumer. The consumer is sitting there on $3.4 trillion of deposits. Coming into COVID, they were sitting on $1 trillion. So there's some buffer there.
Jane Fraser, newly minted Chief Executive Officer at Citigroup, relatively newly minted. Speaking in Davos with David Rubenstein next to her, and what I noticed overnight was the $2 trillion figure topped Lisa Abramowitz in the repo market. As she said, there's a lot of cash laying around.
Yeah, there's a lot of cash, and we do see people deploying it. But even as Bob Prince of Bridgewater was just saying, this is one reason why there still hasn't been capitulation. As bearish as some people are, and as bearish as Mike Wilson will be coming up, there still are a lot of bulls out there that see the potential upside.
That's interesting to say, Lisa. We welcome all of you to the meetings, the World Economic Forum here. It's their 51st year, I believe, maybe 52nd, and we are looking towards January, not official yet, but getting there, according to the people I've talked to this morning here. Lisa will be freezing here in 7 months, the space heaters. Of course, yesterday we had the wind as well, which was itself sport. Market's a bit negative here.
The violin is
churn,
on.
Yeah, the violin's
I'm sure people are really, yeah.
This is an important discussion. Lisa's going to dive into this with Lynn Martin, president of the New York Stock Exchange. But I'm going to greet Ms. Martin for every parent nationwide and worldwide watching, because there are those that talk and there's others that do. And Lynn Martin, along with Sally Krawchuk and a few others that have been in the surveillance orbit, is what we are all wishing and hoping for. What was the pixie dust in your household as a child that got you into computer science and mathematics? What was the magic there that I'm a girl didn't happen?
Great question. Lovely to be here with you guys in person. Thrilled to be doing this in person with you. You know, it really came from my parents. My dad was an engineer. He actually designed fuel gauges for the fighter planes in the US, and he got me into computers as a young child. My first computer was a Commodore 64 that I loved to play on. I'm dating myself here, though.
The reality that we face, and so many listeners and viewers, is the idea that you do math, 8th grade, some algebra, geometry. That's the stereotype. How do we get beyond that?
You know, I just happened to be good at it, and it was something that I absolutely loved doing. It's why when I went to undergrad, I was majored in computer science, minored in math, but I loved math so much that I went on to pursue my master's in math. To me, it was something that, you know, employed a lot of quantitative reasoning, but at some point, math actually becomes art.
Religion.
Well, let's turn math into the present and the math of going public at a moment that is so tenuous for markets. How much are companies rethinking this idea as the public markets get overly pummeled, at least if you look at some of the private ones?
Well, the good news is the demand to go public has never been stronger. What we're waiting on at the moment is what's the right time to come to market. Given all the volatility in the market, a lot of companies are trying to figure out what that moment in time is. Our pipeline's incredibly strong across all sectors, across tech, across consumer, across energy. We actually have seen some innovative green energy companies come to market in the last couple of months on the New York Stock Exchange. But, it's really a question of when as opposed to if, because they very much see the value in becoming a public company.
Although there is this feeling of speed, which is beneficial when the speed is one way up and is really problematic when it's one way down. And we're seeing that right now. We were speaking with a number of private equity executives that say we haven't seen the sell-off, but we are going to probably in 6 to 9 months. Has the speed hampered the reputation of the public markets as a vehicle of financing, given the fact that there's still so much in the private sphere?
I don't think that it has really hampered the reputation of the public markets and the currency that comes along with being a public company. Public company gives you access to a deep, liquid pool of capital. It allows you to reward your employees in a very different way. It allows you to find the capital to do mergers and acquisitions and also invest in your business in a much more meaningful fashion.
But the difference here is in the old days, you bought one share of General Electric and you looked at the Dow Jones Industrial Average and it was very stodgy, like the boardroom of the New York Stock Exchange up top of the building. Things have changed. We have SPACs and how much money people have lost with SPACs. We have the whole GameStop thing. I was pilloried last week about Robinhood and all this. What is the social mandate of the New York Stock Exchange to push against the speculation and gambling that's out there?
Well, that's a good question.
I did okay?
The New York Stock Exchange, though, is very much focused on providing transparent, liquid, efficient markets.
Is Robinhood a responsible market? Is what Ken Griffin and others doing a responsible market?
We're focused on the infrastructure that has been tried and true and built over 230 years and withstood multiple financial crises. And every time
so when you run a trade through Fidelity or Schwab and that, you're getting maximum transparency with you. And what are you suggesting you're getting the other route, the more modern route?
Well, ultimately, what we think the right way to address this is through standardization across what trades on dark pools and what trades on the lit exchanges.
Who's the adult in the room on this? This is really important, folks, for global Wall Street to get trust back. Who's the adult in the room to combine the modern dark room with the ancient New York, Ace Greenberg with a buy ticket here and a sell ticket here?
I wouldn't say that we're the ancient New York Stock Exchange, given the amount of messaging we're pushing through the platform, particularly since we're processing 500 billion messages through the platform every single day at the moment. But it's really around the SEC to harmonize the rules between dark pools and between the lit markets. And that's really all we're asking for in terms of equity market
With transparency being where it is and being the adult in the room, where does crypto fall into this?
Crypto is a market that, in my opinion, needs guardrails. It needs regulation. It needs a proper regulatory structure, which I know the regulators are spending a lot of time thinking about.
And then will it be appropriate for your platform?
Didn't necessarily say that, but we always look and talk to our customers about what they want to see on our platform.
Oh, come on. We've gone from 60 to 29,000. You got a bunch of clowns up Happy Valley telling me Bitcoin is a currency.
Well, that's the question.
You're the adults in the room. Where's Gensler on this? What does Gensler need to do about crypto?
From our conversations with Gensler, he's spending a lot of time thinking about how to regulate this. And my understanding is that he's working with his team to roll out appropriate regulation. But he's got to also balance that versus the future side of the business, the CFTC and other agencies too, because it is a unique animal as to how to regulate that.
Are our kids spending too much time on computers today?
I think computers are amazing. I think technology is amazing. It has enabled us to go from a fully in-office environment to a work from home environment and to a hybrid environment, and has really enabled communication and very efficient communication.
Honestly, can I just say that when she was talking about the old computer, I was just thinking about that dial-up.
She bought it used. She's too young to have a Commodore 64.
I had one of those. Those were amazing. I love that. It has bad memories.
I had a slide rule. Get us out. Take us out.
Coming up, we've got the Prime Minister of Finland.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Good morning, everyone. On radio and television, from the meetings of the World Economic Forum in Davos, Lisa Abramowitz and Tom Keene with surveillance. Great conversations coming up. A really important conversation for anybody of the history of Europe and America. We'll do that here in a moment. On the data front, well, it's a churn. Up we go yesterday, down to me. Turkish lira breaking through to new weakness today is idiosyncratic. What do you see in the data?
It's idiosyncratic, but we are seeing euro strength versus the dollar. A bit of dollar weakness is what Christine Lagarde really doubles down on raising interest rates, but not too fast. 10-year yields a little bit lower, but quiescent, and crude kind of bouncing around, but really it's the retracement in some of the social media stocks. And I know you're wondering what the significance is of that, but I think that's sort of in the forefront of today's
I don't get it. I did get Lagarde's conversation with our friend St. Lacroix, and it was a very carefully phrased conversation with the pressures to the ECB meeting. It's always pressure when we go to Romain Bostic. He is in New York looking at individual securities.
Looking at individual securities tied to the macroeconomic conditions. Remember, yesterday the rally was all about that commentary we got out of J.P. Morgan and Jamie Dimon, sort of that bird's eye view that while things maybe weren't completely all copacetic, there weren't necessarily cause for complete concern. Concern here that we would be heading towards a recession or even sort of economic doldrums. That's now all flipped on its head. This, of course, after that warning that we got out of Snap. Snap shares down about 29% here in the pre-market after the company revised its guidance lower. And I think the significance here isn't just the revision in guidance, but this is a company, guys, that just reported earnings 4.5 weeks ago. And there's a big question now as to what has changed in the last 4.5 weeks to cause Evan Spiegel to put out this warning to investors to let them know that, yes, ad spending user growth may be a little bit softer than what people thought so just a month or so ago. This is not only dragging down sort of the small and mid-tier companies like the Snaps, the Twitters, and Pinterest, which are all down here in the pre-market, but it's dragging down the big heavyweights. Alphabet shares down about 4% here in the pre-market. Amazon lower, Roku lower as well. And then you have some of the pure play advertising companies out there. Trade Desk shares down 7.5%. Omnicom, WPP, and Interpublic all moving lower here in the pre-market. Again, this goes well beyond just ad spending. It really goes to the heart of what's going on with the consumer right now and whether that resiliency is going to be as resilient as some investors had priced in. It's not all gloom and doom out there. We did get some earnings out of Best Buy, and they were actually pretty good. Yeah, they were actually pretty good, Tom. I mean, look, there were a lot of categories with Best Buy that were negative in terms of year-over-year growth, but appliance sales were still strong, and some of the electronic sales, particularly when it comes to computers, were also strong. Those shares up 5.5%. And then we got Zoom, one of the pandemic darlings that had really fallen out of favor. Shares still down 70+% from that all-time high, but they are bidded higher by about 4% here in the pre-market after reporting earnings showing that their enterprise business, basically the business that they use to sell to corporations, that is actually doing well, and there may be enough growth there to kind of sustain this company for a little bit longer. And Albemarle, those shares up 1% here in the pre-market, big maker of lithium, and that company actually came out with a forecast that seemed to suggest that the pricing power that they have right now, as well as the demand, that's going to persist for the near future, Tom.
Roy Bostic, thank you so much. Perhaps I am the ugly American. When I read all of Patrick O'Brien about the Napoleonic Wars, it was always a shock when they went up to the Baltic Sea. Oh yeah, there was politics, battles, and wars up there. And yet the same thing happened in 1939 with Herman Valk and War and Remembrance. Oh yeah, there's a Baltic Sea, there's wars, politics, and battles up there. It is now the same, and a great mystery to Americans that we don't study in school is 3 months, 1 week, and 6 days of the winter war of Finland and the Soviet Union. Lisa, 25,000 missing and dead for Finland in 3 months.
Yeah, just tragic. And what does that mean for going forward, given the proximity of that region?
And is any of that within the history of what America knows now as we look at a new NATO? Alexander Stubb joins us, the former Prime Minister of Finland. Honored to speak with him this morning. We are ignorant of the moment, and I would suggest, other than Mr. Stoltenberg here at Davos, you are by far the most important person in the NATO community. How close are you to joining NATO?
Well, we're very close, and things have gone really fast. And I think the decision actually on Finnish NATO membership was taken in the morning of the 24th of February when Putin attacked Ukraine. That's when our opinion polls changed, and the latest one is now 80% in favor. And, you know, on top of that, we had 188 in the parliament.
Within the politics, there is this collective memory of the Winter War. With an 800-mile border, how feasible could there be a winter war where Russia attacks?
Finnish case, not very feasible. I mean, we expect probably some hybrid attacks in the form of cyber and information wars. But of course, the winter war lasted for 105 days. So that's a very long time. And now we're into pretty much day 90 in the war in Ukraine. And I just spoke to some Ukrainian MPs, and we did some comparing and contrasting in the situation. Of course, history never repeats itself, but in this particular case, it rhymes.
How is Finland able to be so bold with the consequence of the retracement of gas supplies from Russia? How did Finland get away from the dependence that Germany still has?
Well, we're pretty cool, calm, and collected in these kinds of situations. On top of that, we're quite strategic. So we've seen, energy being weaponized, and that means that 100% of our gas used to come from Russia, but it was only 5% of our overall energy consumption. So we were able to switch grids like that, and it only actually went to industry. So we're very self-sufficient on this. We're not dependent on Russian energy, which makes, of course, our position quite comfortable.
So then why was this decision not made earlier? Sort of why is this an important moment if the concern isn't that perhaps Russia, that Vladimir Putin will lob a nuke over to Finland?
Well, we weren't really worried about that part. We work with, of course, the European sanctions as such. And we expected that when we join NATO or apply to join NATO, we will get these types of situations. And we didn't need to do it before. To be very frank with you, if I recall from my times in office from 2008, 2016, Russian gas was pretty cheap. So it was an economical decision at the time.
I want to talk about, and again, this is the collective American memory. I mentioned Herman Valk earlier, and now essentially no one saw 1939 coming. That's the arching plot of his 3 books. And the fear that we have now, along with the fears, the memories of World War II, is the reality that we could have a World War III. And in every guest we've talked to, they said it's overdone. Do you, as a leader of your nation, or the Scandinavian states, are you worried about a World War III?
No, we're not.
Why?
Well, I think we human beings have a tendency to do 3 things, right? We over-rationalize the past, we over-dramatize the present, and we underestimate the future.
Okay, so that's the Americans. What does everybody else feel?
No, I think the starting point here is that, of course, the war in Ukraine, we didn't think that conventional warfare would come back to the European borders because the alternative cost is so high. But the reason we don't see this happening as a world war is that we'll see a split Europe. On one side, you have Russia, which is aggressive, imperialist, and revisionist, and on the other side, you have 40 European democracies. And I think, Ukraine will grind this out, and this will not spill over to World War III.
How much can the U.S. be a leader if there is such a fissure within the nation?
I think the U.S. has done very well, but to be very honest, what we're seeing in the U.S. now, the U.S. and the Biden administration is able to bring Europe and NATO together, but the U.S. society as such is quite split. And you know that I did my undergraduate work at Furman University in Greenville, South Carolina. So
nice.
That was an amazing
So I
accent.
follow American events very closely, and I think the fear in Europe is, if I may, is that we don't know whether Joe Biden or Donald Trump is going to be the footnote of history, and this is what a lot of Europeans are preparing for.
Respond to Mr. Erdogan's comments on Sweden, on Finland, and on support of the Kurds.
Okay, so I think what Erdogan is asking for is 3 things. One is linked to the Kurds, and especially PKK. The Finnish president has taken a very strong stand defending Turkey on this and helping them on security. Second one is an arms embargo that we imposed on them in 2019. And the third one is actually about American F-35s when the Turks bought Russian S-400 missiles. Now, I believe in diplomacy. Finland and Turkey have always had very good relations, and I hope that we'll solve it.
This is critical. Elliot Cohen in Foreign Affairs talks about a return of statecraft. Prime Minister Stubbs, you have practiced statecraft. I mean, people watch you going, how can this young guy from Finland, why are all politicians in Finland young? What is this about? What's in the water?
Well, listen, if I compare myself to our current Prime Minister, I feel old and decrepit. So,
how old is the present Prime Minister roughly?
She's 35-ish.
She admits to 35,
Yeah,
okay.
exactly.
In America, they're 95, okay, that's where we are. Seriously, when you look at where we are right now, the span from Helsinki to Istanbul is unimaginable to most people. How will we bring that span together across the Eastern Front?
Well, I have a few experiences with Turkey and Turks. The first one was when I was a young civil servant in 1999, Finnish EU presidency in Helsinki. We opened the door to Turkish EU membership, the accession negotiations. So that was, point number 1. Point number 2, I actually established as foreign minister in 2008, 2009, the Friends of Peace Mediation, together with then foreign minister Ahmet Davatoglu, who later became prime minister. And I'm sure that this will carry over. And I hope that the president of Turkey will have a positive view on us.
That sounds so Finnish, the Friends of Peace Mediation.
It's
very, which is not exactly perhaps some other nations. I am wondering here in Davos, where people are talking, that's what they say at Davos, right? Where basically people are defending globalization amid a surge in populism and anger at the globalized system. How have you heard that talked about in your meeting with so many people, given that this is basically a celebration of what so many people are trying to basically fight?
Yeah, I think it's sort of an end of an era, in the sense that this is the 1989 moment of Davos as well. Then we believed in the end of history, Fukuyama, globalization, liberal democracy, but now that's going to be topsy-turvy. I personally think that this is not going to be an era of deglobalization, but the regionalization of globalization. And the reason I say this is that a lot of the value chains are now being brought back home. Why? Because of Trump, because of COVID, and because of the war in Ukraine.
Final question. I was watching Denmark-Canada in ice hockey last night. You have a heritage in ice hockey that is truly global, far beyond the excellence of Finland. Is it time that the goal in hockey be made bigger so we can get back to the game that the Lake Gila-Fleur knew?
There we go.
Well, you know what? You asked me this question the last time around.
But now it matters because the Lake Gila-Fleur agreed with me that hockey's a mess.
You know what?
We need a bigger goal.
The great Gila-Fleur actually visited my home in 1981, 1982 during the World Championships, and I was very sad to see him pass away. And I'm actually going to Montreal for the draft because it'll be my dad's 40th draft. He's been the chief scout of the NHL for the past 40 years here in Europe. Should it be widened or not? I don't think it should.
There was a political answer, if I've ever heard, from the former Prime Minister of Finland. Alexander Stubb, thank you for the important conversation, this historic moment for Finland and the country to the west. What's it called? Sweden. I got it.
Good job. That was ace. Did really well. Really interesting, though, especially given the foresight to remove the reliance on gas, allowing them to have the flexibility to be bold.
Let's cut to the chase. Stubb has already left. They didn't screw up like the Germans.
Well, that was the subtext there. You did it very well. Basically said, there you go. And basically, it was an economic decision that turned out to be a national security disaster.
A data check futures at negative 40-ish. I'm going to call it. Dow futures showing you a couple hundred down as well. Yields go back and forth first 2 days here in Davos. The idea of yields up nicely yesterday, coming right back down to get 4 basis points, 2.81 is well. This gives us the time on the dollar here in Davos. It is a point of discussion.
It is, absolutely. Will it remain strong, or will we see this be the tipping point over the past few trading sessions?
Every year there's one word where I just want it to go away, and this year's word is resilient. Everything's resilient.
I'll make sure to use it as much as possible.
The barley soup was resilient last night.
So is my spirit, and so is yours.
Coming up, an annual visit, the leadership of Marriott International, Mr. Capuano. Stay with us. This is Bloomberg. Good morning.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Rates getting into positive territory is a good thing, in my view. We can make bigger steps there. Real rates are still negative. Therefore, I do think that from a policy perspective, it may not be as bad to make those moves. And it builds you a buffer for ammunition when you need it again.
Bill Farmers, UBS CEO, speaking to Bloomberg here at Davos, his Switzerland. We welcome all of you to the meetings of the World Economic Forum. Lisa Abramowitz and Tom Keene, Jonathan Farrow is off this week. The fog is set in, which is very difficult because every photograph on the Marriott website is of clear, bright, sunny skies.
It's true.
There's never fog on the website
It's true.
of Marriott International. Joining us now, their Chief Executive Officer. How many hotels is it? 8,000?
A little over 8,000.
8,000 hotels. Tony Capiano with us this morning. The wage war, $18 an hour, $20 an hour, $22 an hour of Fortress Moynihan. We'll speak to Brian Moynihan later, a couple hours out. What are you and your franchises doing about the wage war?
So a few things. Our total vacant positions of about 8,000 is almost exactly what our steady run rate was pre-pandemic. The difference is pre-pandemic, they were relatively evenly distributed. Now they're concentrated in the markets that have recovered most quickly. Obviously, we need to be competitive on wage. We've got to identify folks that want hospitality as a career. 1 in 5 jobs that were lost came out of travel and tourism.
Do you get the sense that actually there is a bigger pool of applicants for each job, that the labor market is starting to get a little easier?
It is, but the challenge for us is many of those applicants have no experience in travel and tourism. And so we're getting increased applicant flow, but the training curve is a lot steeper than we've been accustomed to.
When it comes to the demand side, there's an issue right now where we've seen an incredible boom in travel and experiences. Everyone wants to get back out there, but we're starting to hear on the margins, people are getting concerned that the ability to pass along costs is starting to get a little bit more difficult. Where are you in that?
You hear those rumblings, but we don't see it in our data.
Okay.
We had a little step back in January and February because of the Omicron variant. But March, global revenue per available room was only down 9%. versus where we were in 2019. And in April in the US, our biggest market, we were back to 19 RevPAR levels. So we're just not seeing it yet.
In Venice, Italy, there's a Marriott, which is an image that is shocking. You have your wonderful island, almost separate island property. And then you go by the Hotel Danilai, which is like in every other movie. I think Cary Grant, like 12 of his movies was shot in front of the place. How do you get the romance of your Venice, Italy into the rest of the Marriott system?
Well, I think we expose our customers through the program. We share that imagery, and we encourage them to explore all the new destinations. We'll open hundreds of new hotels. This year, we're in 100.
Which price point do you want to be in?
All of them. That's one of the benefits.
You think you can concede on a profit margin basis by meeting every category of property?
We do. And in fact, during the pandemic, our limited service hotels were the ones that recovered most quickly.
How quickly are you able to raise the prices?
Pricing power has been extraordinary. I think when we look back on the pace and the trajectory of this recovery, the speed with which pricing power returned will be the most notable issue. In fact, if you looked at post 9/11, post Great Recession, it took the industry 4 to 5 years to get its pricing power back. It took less than 2 this time.
Has it decelerated at all, or do you see that basically not meeting any resistance?
And Tom asked a little bit about across the price tiers. In the first quarter, luxury average rate was 27% ahead of where we were in 2019.
What about below that, though?
Yeah, we continue to see pricing power across all segments.
Look, Tony, and you mentioned it, limited service. I was speaking with our Michael McKee, who lived on your concierge system, which I guess went away with the pandemic or whatever. McKee wants full service. I mean, he's hugely demanding. He's a pain in the ass for Bloomberg. But the bottom line is a lot of us want services, and that you're telling me what people really want is this phrase, limited service. Comment on that.
Certain customers at certain price points for certain trip purposes.
They don't want room service?
If you are arriving at 10 p.m., you're going to sleep for a few hours and you're out the next morning, you want a clean bed, a hot shower, and great Wi-Fi. On the other hand, that same traveler, he or she may spend 100 nights a year in that select service hotel and then take their family to a luxury resort where they want spa, full capacity, all the restaurants open, room service.
That's Tom Keene and his family. Going forward, where do you see the greatest growth? Is it going to be in some of those urban centers like New York City and San Francisco? Will they come back, or will it continue to be in some of the tertiary cities?
I think both. Certainly in terms of pace of recovery, we've seen leisure destinations and secondary markets recover most quickly. Some of the urban markets have been a bit slower to recover. So we see lots of opportunity for continued growth there. But we'll continue to grow our brands globally. One of the things that was most notable to me, we talked about this on the earnings call, we approved and signed more deals for new hotels in the first quarter than in any first quarter in our history.
Wow. You know, we talked about this the last time that you were on Surveillance. You were talking about how the demand has come from vacation and not as much from travel for work. Has that shifted?
What we're really seeing a shift towards is blended trip purpose. It's been interesting the last couple of days in Davos. I think everybody I spoke to spent a couple days in Paris before they arrived. You talked to lots of folks that are going to tack on a few days of leisure travel at the end of the conference. And this desire to pair business and leisure travel, we think will endure beyond the end of the pandemic.
Tony, people have to mortgage the middle child to pay for the airfares to Paris now. When you look at the surge that we've seen in airfares to Paris, hugely popular, what does that do to your reservations in Paris?
Well, again, our forward bookings into the summer season into Europe are as strong as they've ever been. So I think what that suggests is the breadth of our portfolio allows those that have more disposable income to take on those costs. And at the other end of the income spectrum, we expect to see drive-to destinations, particularly domestic drive-to destinations, continue to thrive.
I got to ask one financial question. What are you going to do with use of cash 12 months forward?
Well, I think you may have seen in the first quarter earnings call, we reinstated our dividend. I think we talked a little bit in the earnings call about considering share repurchase. And as we always have...
I got to make some news here. I'm making no news with politicians. Help me here. Are we going to see some repurchase?
Yeah, I think you likely will. We've set some targets around where we want to get in terms of our debt ratios. But we'll continue to look. And if you look at the way we've come out of other downturns, we've started with the dividend and then pivoted to
I'm going to tell you something for John Farrow as well. What you've done in memory of Arne Sorensen, fabulous.
Thank you.
You've killed it.
Yeah.
Take us out of here. Arne Sorensen died tragically, folks, here at Davos of cancer. And this guy, Capuano, picked up the pieces like no one.
Tony Capuano of Marriott International, thank you so much for being with us. And I got to say, the pricing power, just amazing.
You call it pricing power. I mean, I call it say what.
Yeah, you call it say what, which is what we all do when we go on vacation. Coming up, Mike Wilson, Chief U.S. Equity Strategist at Morgan Stanley, perhaps doesn't have quite the same optimism, which I think is important.
You have a tradition on your vacation. You sit in the Atlanta airport for 15 hours.
Bring that up. I don't want to deal with that again. From Davos, this is Bloomberg.
nuestro estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
you're still seeing people just very apprehensive to invest.
There's been carnage in growth, public growth stocks.
If the Fed continues to tighten to try to reduce demand to get inflation under control, I would expect to see that flow through into discounted growth.
There's a lot of negative things going around in the world away from the U.S. that could really drag the U.S. market down.
Discontent has become global. We've had globalization of global discontent.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From a less windy but more foggy Davos, Switzerland at the World Economic Forum, this is Bloomberg Surveillance. Good morning. Is that the effort at wind? And we have an actual audible wind storm next to us called Tom Keene. I am Lisa Abramowitz, John Farrow on assignment. And I got to say, the fog really sets the tone for the moment that we're in.
It really rolls in. Yeah, absolutely, Lisa. You know, it's a silly metaphor, but it really works here this year. There's a somberness, and I'm going to go right to the website of the World Economic Forum. Klaus Schwab wrote a note this year that was, as I've never seen in 51 years. I mean, there was a somber tone of this war in Ukraine.
And not only that, but the supply chain disruptions and how you recreate the spirit of a globalization that's being rejected by so many different populations. And I got to say, the backdrop of markets yesterday quiescent, but today, I would say a little less so. There is another downward tilt, and it comes after Snap. And I know that you wonder what kind of company it is. A lot of people call it social media. But Abercrombie and Fitch also coming out with some potentially negative headwinds, basically talking about some of the supply chain disruptions that have been greater than expected.
Well, I had a conversation on this yesterday, and I don't think it's been played enough here. If China opens and Shanghai unloads, where do the boats go to?
Yeah, that's a good
question.
How
do you unload them?
Yeah, I mean, how do you deal with the fact...
This is another worry, I guess, to worry about.
That you get so many disruptions. How do you deal with volume that you're not accustomed to? I will say, also coming out, while Davos was taking place, were a number of downgrades to the potential Chinese growth outlook. How does a world economy deal with 3% GDP growth in China?
We part on this. I'm more optimistic. I think technology will slip in here. I think that there will be adapting and adjusting the emotion of coming off a bottom. Let's do a data check here real quickly. Lisa's going to tell you about the view forward as well, and then it's only appropriate that she bring in our next guest. The data front is real simple. Up we went yesterday, down we go today. Futures negative 46, Dow futures a negative a number of 100 points. Lisa's noted the strength in the euro. Part of that, Lagarde comments to our Francine Lacroix. 10-year yield gyrates round trip over 48 hours. And I do want to notice just idiosyncratic Turkish lira pounding through 16 this morning. That's a large deal for a politically challenged Mr. Erdogan.
That's so political. It seems like you've been hanging out with politicians.
No, but I think it's idiosyncratic, but within the war. And I'll tell you, one of the symbols here is Alexander Stubb coming in, and he's got the Ukrainian handkerchief in his suit.
How about the Russian war crimes setup that they had for the Russian representatives? It used to be. Right now, I am so thrilled to have Mike Wilson on. He is Chief U.S. Equity Strategist at Morgan Stanley, who reflects some of the pessimism represented by the silly metaphor, as you called it, of fog. But Mike, you recently put out a note where you talked about 3,200 as a realistic possibility for the S&P. What could get us there?
Yeah, it was actually 3,400, but you know, what's 200 points, I guess, in the bear market. But look, I mean, it's valuation driven as well as driven by technical support. So, you know, I think our sort of out of consensus view this year, which has come true, is that multiples had to come down. And that was a function of course, the Fed and rates going up with slowing growth. That combination is pretty deadly. And, you know, and of course, the war, unfortunately, just made, you know, both sides of that argument worse. So we've gotten to our price targets on multiples of 16.5 times more quickly. But now we think that multiple target is lower because of the war and other issues that are out there that mean the earnings probably come down even further. The risk of recession has gone up next year. And so it's 14.5 times, which is a 400 basis point equity risk premium, which is not, you know, an aggressive number. And then from a technical standpoint, you know, the 3,400 really jives with kind of our overall view. That's a 200-week moving average approximately. It's basically pre-COVID levels, and that's where the Fed put kind of lives. So there's a lot of reasons for the 3,400, and we just don't think it's finished yet.
Do you think that the stability that we're seeing right now in bond yields, with just tepid moves after some pretty violent moves upward in yields, price down, do you think that we have reached some stasis, stability that will give us a floor at least in the near term?
Yeah, it's a great question, Lisa. I mean, we've been probably more, I would say, neutral-ish on long duration. We feel like that there was an overshoot to that 320 level that was, just like over a couple of days. And the reason why we think, bonds have overshot is twofold. Number one, we think there's a lot priced in for the Fed now. It's a very aggressive path, particularly given the slowdown in growth that we're seeing now. And then secondarily, I mean, that's that second part of that question. I mean, the growth is starting to disappoint. So bonds are starting to look actually relatively attractive to stocks, and the asset allocators are now starting to move. That's one of the reasons why we've seen this recent moving. Bonds have outperformed stocks by about 7 or 8% this month. And we think that is the asset allocators moving. We did the same thing, frankly, in March and April. So that stabilization, to your point, I think could lead to perhaps maybe some of the longer duration growth stocks doing a little bit better. They have taken most of the pain here. That doesn't mean they're going straight up. It means that they maybe on a relative basis can do a bit better.
Mike Wilson, you have in your research note a phrase which I hear too often in Davos. It's a fancy academic phrase from economics and finance folks, and it is necessary and sufficient. You can have a necessary and sufficient Davos. Mike Wilson, we've got some gloom out there. You say it's necessary, but it's not sufficient. What do we need to go up?
Exactly right, Tom. I did pull that phrase out for the right reasons, I think, which is, people are bearish now. And that's a big change from 6 months ago when I think everybody was overly optimistic about markets. Forget about the economy and earnings, but markets had overshot. So that is good. That's sentiment. However, positioning is still pretty ebullient. And we measure that when we look at the asset, once again, the asset owner community, as opposed to the asset manager community. The asset owner community is way more important and significant for direction of markets. If they decide to go student body left or student body right, that'll overwhelm any kind of short-term trading strategies. And what we're seeing right now, going back to what I said earlier, we are seeing student body right a little bit, going back from stocks back towards bond.
If we use the VIX as a metaphor for this, Mike Wilson, do you have sufficiency with a stochastic VIX from, say, 30 out to 40, or is it more of a trend or moving average study where I need to see some persistency at a 40 level?
Yeah, I mean, all bottoms are different, Tom. I mean, we're clearly in a bear market. The question is what's going to form the bottom. Some bottoms are very sharp, like in March of 2020. We thought that was pretty visible and easy to see with the stimulus. This is not going to be like that in our view. This is going to be more of a grind, kind of rounding bottom is my guess, multiple retests, because, look, I mean, that everybody's kind of been involved, and the VIX may not need to spike. It's just going to stay at a more elevated level. In fact, one of the missing ingredients is we're not seeing that spike because we don't think we're going to get full-on capitulation. This is more of a drift lower as these asset owner, accounts are much slower to move. It's more of an overhang on the overall market as opposed to a capitulation.
Mike, do you think people are overestimating the strength of the consumer?
I mean, that's probably been one of our big out of consensus calls that we, kind of argue with clients. I mean, clients have been much more bullish on the sustainability of these trends. Like we're not calling for the consumer to shrink this year. Our view is, when we think about markets, Lisa, not necessarily consumer. And what's happening is the consumer is going from an extreme level of spending, call it 7-8% growth in PCE, to something like 2%. So while that's not negative growth, it's going to feel like negative growth to a lot of these companies that have been building inventories, building for business at a higher level. It's the rate of change. And I think that's the difference between our view and others.
Mike Wilson, thank you so much with Morgan Stanley here this morning. He has been Lisa, it's just stunning how he's been dead on.
Yeah, he has been, and he sees that 3,400 mark, as being possible for the S&P. And I gotta say, how much capitulation, if there's not gonna be a wholesale capitulation, you have to get if there's a drift lower. By the way, someone on Twitter asking you for a friend if you can invest in the triple leveraged goat fund from Switzerland.
Well, no, we've got the goat fund here. They've been talking. I don't know if you can hear it on radio, on television, though, but where Lisa and I are sitting, the goats might as well be like 6 feet away.
Yeah, they're heckling us. No, literally, they're heckling us. They're just sort of buying in our ears.
You know, this is the Ellen Zentner goat farm on this section, brought to you by Morgan Stanley. Ellen Zentner is one of the great fly fisher people of the Wall Street business, and she was over fly fishing in Switzerland once and picked up 40 acres of a goat farm.
The goat commentary.
Can we show the on radio? This is important.
You didn't know that
I got to describe this for radio. It's
Clearly.
unfair. It's like avalanche territory here at Davos. There's like literally those safety gates up, seriously, protecting from avalanche. And they're using it's the frugality of the Swiss. They've got different strains of lambs and goats. Yeah. And they've been very vocal during the show.
And they have little bells around their necks too. So if you get a little closer. No,
the cows.
They also have them around some.
They have their bells too.
They have some. I hear bells. Anyway, we have a lot of much more serious conversations.
About 11 p.m. last night, I was running around with the goats.
All right, good to know. That explains a lot. Honestly, I will say, coming up, we have a really important conversation on just the strength of Europe at this really tenuous moment, especially given some of the inflationary pressures, Tom.
Joining us, Pedro Sanchez. He is the Prime Minister of Spain. Looking forward to that conversation. Again, the meetings of the World Economic Forum in Davos. Stay with us on radio and on television. We'll be here Wednesday and Thursday as well. And I'm told in January. That's a good thing. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Shares of Snap are plunging in pre-market trade and they're pushing other social media stocks down too. Snap cut its revenue and profit forecast below the low end of its previous guidance. The company also will slow hiring. Snap benefited from a surge in usage of its Snapchat app during the pandemic, but business is slowing as people return to offices and schools. European Central Bank President Christine Lagarde says the currency bloc has reached a turning point in monetary policy. In an exclusive interview with Bloomberg in Davos, Lagarde said the ECB isn't in panic mode, but she said it will move out of negative interest rates by the third quarter. Lagarde also rejects the idea that the euro is heading for a recession. Europe's two largest economies kept growing in May. Germany and France benefited from a sustained rebound in services that offset fallout from Russia's invasion of Ukraine. S&P Global gives the credit to the loosening of COVID restrictions in both countries. Meanwhile, manufacturing was weighed down by rising prices and supply chain problems. The Biden administration's trade representative says the U.S. must be strategic when it comes to deciding whether to lift tariffs on Chinese goods. Catherine Tai told Bloomberg that it has to be done in terms of how to effectively realign the U.S.-China trade and economic relationship. On Monday, President Biden said he would consider removing some of those Trump-era tariffs. And more Americans are quitting their jobs than ever, and few are sticking around in their new positions. Amongst workers who took a new job in 2021, the share who had been in their previous position for less than 12 months rose by 6.5%. That's compared with a year earlier. That is according to LinkedIn. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. On the moon.
Can ESA help humanity take its next giant leap?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
The result of a monetary inflation is high nominal GDP growth, and then that gets absorbed by prices, and so you get low real growth. And that produces stagflation. We're on the cusp of it, yeah. And it's how do you define stagflation? There'd be different ways, but basically the way we look at stagflation is in terms of how it affects markets.
The economics of Bob Prince of Bridgewater Associates, of course, working with Mr. Dalio, Rebecca Patterson, and others. They're having a very good year. Some really interesting talk there about nominal GDP and how it folds into return. Bob Prince was spirited, to say the least.
Yeah, he was. Perhaps it was the goats in the background, which, by the way, Al from New Jersey wrote in, they are not goats, they are sheep, and that we city dwellers just don't know the difference.
Yeah, goats make for better TV. Lisa Bramwitz and Tom Keene here. John Farrow off this week, and we welcome all of you to what's become a really interesting and different conversation of Europe. As we just spoke with Alexander Stubb of Finland, we now speak with the Prime Minister of Spain. Pedro Sanchez joins us this morning. Lisa's going to start with the obligatory questions on Europe, the moment, the war in Ukraine. I want to talk to you about how thunderstruck I was as an uninformed American on the stunning depeopling of Spain. Everyone's in your Madrid. Everyone wants to go to the Prado and an X number of other important cities, including down in the Mediterranean in Spain. The arch American fear is the depeopling of the plains, the Midwest. You're living it in Spain right now. How do you push against the depeopling of rural Spain?
Well, I think that this is one of our major challenges, the territorial cohesion, and that is why, in our Next Generation European Union funds, we are more or less allocating 70 billion euros for the next years. One of the horizontal, transversal political goals apart from the ecological transition, the digital transformation, the gender equality, will be the social and territorial cohesion. At the end of the day, it is important not only to have social cohesion, but all the territories from Spain have opportunities to develop.
How does that social cohesion and the geographic cohesion fold into the modern Spanish capitalism? With the politics of Spain, the fractious nature of the politics of Spain, what will be the form of capitalism that will advance that technology to all of the people of Spain?
Well, I think that if we compare the response that the European Union is giving first to the pandemic and afterwards to the economic consequences of the war, compared to the financial crisis in the year 2008, is completely the opposite. So we are now having public funds for public investments in order to modernize our economy on digital and ecological transition. And after and at the end of the day, also to invest in people, in human capital. So that is why we are not only allocating public investment for this modernization, but also we are transforming our regulation. For instance, a huge revolution in our educational system, in the labor market, pension reform. So we are actually transforming Spain in a very positive way.
Prime Minister, how much of a challenge, though, has energy prices been, and have you done everything that you can do to bring that price down?
Well, absolutely. Absolutely. I mean,
are you looking at additional measures?
No, we are allocating 16 billion euros in order to help our population, also specific sectors that are very touched by the increase of the prices, especially the energy prices. But we have done other two things which are very important. The first one is to agree with the European Commission and the European Council that the Iberian Peninsula has its own reality. That is to say that we are a kind of energetic island, because the interconnections that we have through the Pyrenees with the rest of the European Union are, it represents less than 3%. So that is why we are an energetic island. And also we have 57% of our installed capacity comes from renewable. So our energy policy and energy mix is different to other places in Europe, not only Spain but also Portugal. So that is why we agreed with the Commission to fix a price cap, a temporary price cap for gas, for electricity generation. And I think that with this we are also going to reduce the wholesale market.
Perhaps you're managing through this. There are other nations that are struggling a bit more and could potentially struggle all the more so if some of the gas supplies are cut off from Russia. Are you prepared for some sort of recession in Europe that could hamper the Spanish economy?
Well, I think that, of course, this, the economic consequences of the war are harming the situation of the economy in Europe and of course in Spain. It is also true that we have good fundamentals, strong fundamentals of the Spanish economy. First, because only less than 8% of our gas imports come from Russia. Less than 5% of the oil imports comes from Russia. And as I mentioned before, 57% of our installed capacity is renewable. So we are much better prepared. Mm-hmm. And not many people know, but 1/3 of the total regasification capacity of the European Union is located in Spain. 50% of the LNG storage at the European Union is located in the Iberian Peninsula, which is the problem that we are facing, the lack of interconnectivity. And that is why I think it's really important to invest in those interconnections to provide also from the south of Europe alternatives to the Central and Northern Europe.
We could carry this forward, and I could say, what did Spain get right and Germany get wrong on natural gas? But we don't want to go there.
No, I won't say that.
Thank you so much.
We want to go there.
Thank you for joining us today. Pedro Sanchez is the Prime Minister of Spain. So much to talk about there, and really what's interesting after Spain and then Finland is the unevenness of the hydrocarbon sweat.
Yeah, the unevenness and the lack of connectivity, as the Prime Minister was just saying, and how do you build that out at a time of stress, especially when, yes, there is some spending capacity and more being brought online in terms of fiscal spending, but the pressures of inflation from Europe to the U.S.
One of the things that's really hung over me is the 100-page J.P. Morgan document of about 6 weeks ago, where Christian Malik and his team frame out $120, $130 Brent.
Yeah, and then...
Are we prepared for that?
Well,
I don't think we are.
And is that even relevant when there's the refineries that are really becoming the problem, and that you don't have enough fine refined goods to really sustain a decline, a steady decline in the end product for consumers?
Let's frame the market right now. We had an up market yesterday off the comments of Mr. Diamond at their investor day. We come back today on Snap-on Tools, really not doing all that well. The wrenches just not selling like they were. And so we come back down a little bit. Futures at negative 48, Dow futures negative 226, and the yield comes right back up 5, down 5. It's like the winds yesterday.
Yeah,
you know, it's
needs to be glued down.
This kind of thing from yesterday. This is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Bloomberg surveillance, the meetings of the World Economic Forum in Davos, an eventful day, and of course meetings through the evening, all into the parties tonight and on to tomorrow. Lisa Bramowitz and Tom Keenan, we welcome all of you. What's your number one thought here now? We're sort of halfway through.
Halfway through Davos. I do think that there is this feeling that people are willing to say things off the record about the outlook than they would otherwise say. And there is a great degree of concern of how things are going to proceed going forward.
Everybody's looking at their cell phones, but they're not looking at the markets. The markets are pretty quiescent. We'll get to that in a moment. To me, what they're looking at is the news flow, including joint Chinese-Russian exercises somewhere near Japan as the president is on his Asian trip.
Yeah, a lot of people have been talking about the need to speak with policymakers, right? Executives have been talking about how they are so happy to have a chance to get some visibility. Are tariffs going to get lifted? Are they going to be imposed? What is the potential embargoes? And that, I think, is also a massive focus here.
Yeah, what's important, and we just got this email, we're going to rip up the script here. Qantas emailed in, and he said the data checks have really been suspect. Go feed the goats and the lambs. So we're going to go to a data check in New York with farm girl Kaylee Lines. Good morning, Kaylee.
Good morning, John. I am neither a goat, a lamb, or a sheep, but I am watching these markets. And after the gains of yesterday, we are seeing losses in the future session this morning, and perhaps we shouldn't find that all too surprising. My producer, Pete, pointed out to me earlier today that in the last 10 days, we've seen a gain of at least 1% on the S&P 500. 9 of those times have been followed by a loss for the index, on average by about 1.4%. And lo and behold, futures are down about 1.2% at this point in the session. Of course, it's a little bit worse for the NASDAQ 100. Those futures down about 1.8%. That's largely a snap story, which I will come back to in just a moment. But as you're seeing selling in equities, there is some buying in the bond market. 60-40 is working this morning, down about 4 basis points on the 10-year yield, 281. Is where we sit at the moment, and it is a fractionally weaker dollar, or perhaps more so a stronger euro. We're back out to around 107 on euro dollar, the highest level we've seen in about a month. A lot of that thanks to Madame Christine Lagarde, who was out with that blog post yesterday saying that negative rates will be a thing of the past for the euro area by the end of the third quarter. She reinforced that idea in an interview from Davos here on Bloomberg Television this morning, also played down the risk of a European recession. As for what is weighing on the equity market on an individual level, I mentioned Snap really creating a drag across tech. It already had expectations for profit and revenue that were below what Street expected. Now the company cutting it even below its own guidance, saying that the macroeconomic environment is deteriorating, talking about inflation, supply chain issues, the war in Ukraine, all of that affecting the way advertisers want to spend on the platform. So Snap shares are down 33% in early hours. Pinterest and Meta platforms also lower by about 15 and 8% respectively. So a big drag on social media peers. And guys, I thought the commentary out of Abercrombie & Fitch was super interesting. They reported a 27 cents per share loss in the quarter. That was far below analyst expectations, who saw a 6 cent per share profit. But the company talking about higher costs on supply, on freight, on production. And to offset that, they are pulling back on promotional activity. Of course, that promotional activity pullback not offsetting all of those higher costs. That stock is down 28%. But guys, that sounds to me like exactly what Snap was talking about, Tom.
Kaylee Lyons, I'll pick it up from here. Thank you so much for that. Right now, just to focus on the markets, one of the big questions, Tom, that I think a lot of people have been wondering is how much we have found bond stability. We had this massive sell-off. You talk about trying to recoup some of the gains. We are getting an increasing number of Wall Street strategists pointing to new stability as duration becomes more attractive. Michael O'Rourke joining us now, Chief Market Strategist at Jones Trading. Michael, do you buy this? Do you buy the stability that we're seeing right now in the 10-year?
I buy it in the sense that it's regained its haven bid. So with the volatility we're seeing in the equity market, investors are going back to bonds. It doesn't mean that they won't resume their sell-off at some point, but obviously they're looking for something a little more comforting amidst what has been a really rocky 2022 for the equity market.
And Michael, this is actually something that Bob Prince was saying as well, and we were hearing about this rotation, Mike Wilson as well, rotation away from stocks and into bonds. And yet some people are saying that bond stability will lead to stock stability, that's actually been the big factor here that's been driving some of the volatility. Do you buy that, or do you think that there are more losses to come on the equity space?
Yeah, I think short term you see bond stability helps stock stability, but longer term what you're seeing here is a repricing and a re-rating of the U.S. equity market. So like I said, it's you're getting the short term stability, but obviously just looking at the news today, there's still so much uncertainty that is unfolding in 2022, and there's more to come. So I do see more equity weakness out there.
The equity weakness comes from a lack of bid. What are the technical indicators, the inside baseball indicators that show a dearth of bid, which is where you go down further? I'm thinking about, ancient stuff, Michael, like put-call ratio and the rest. What do those tea leaves say about the spirit of the bid?
Well, I one thing that, I'm focusing on here is volume. We've seen volume dried up, and we see it drying up, especially during the rallies. Bloomberg had an interesting story last week, just talking about the put call dropping very low, and there was a lot of call option buying in the spiders and the Qs as hedge funds who had de-risked look for upside protection. And again, people looking for that upside exposure, that upside protection, just shows they're not confident enough to own the actual market itself. So the one last thing,
Michael, the headline thing here, though, in terms of liquidity, is $2 trillion in the overnight trust market, the repo market. Are animals like you suggesting that money needs to move over to equities to establish a bid?
Absolutely. It won't move to equity. So people shouldn't be pushing for that. That's obviously safe money. People have it parked at the Fed just because they need it in a safe spot. Actually, when the Fed starts its balance sheet normalization process, I expect that's where that money will go. It will go into those fixed income, those treasury instruments that come back on the market, but they're not coming to the equity market.
Michael, we're watching Snap shares down more than 30% after a downside projection for what's to come and an unexpectedly deteriorating macroeconomic backdrop. Is this a harbinger? Is this part of a bubble bursting in tech, in pockets of tech, or do you think that this is an idiosyncratic story having to do with a number of social media companies that have been overpriced?
Well, I do think it's a bubble busting. I think this is very similar to the 2000-2002 environment. I mean, there's a number of technology names, number of growth names that are already down 60 to 75%. And we're coming out of an environment where 2021 is probably going to prove to be a peak year in earnings. And that was a very, very stimulus-driven year. So now we look at the second half of 2022. Obviously, we're going into more tightening as the year unfolds. We have more interest rate hikes to come. We have balance sheet normalization to come. So I think that's what the volatility here is, and that's why these repricings are so dramatic. Is people don't know where the real trend of organic business is, and when these growth stocks stop growing, it's a big problem.
So when do you get the courage to buy? Right? When do you have a sense that we've hit a bottom?
So there's two major indicators that I'm following that I think are really important here. One is financial conditions. Obviously, Chairman Powell has talked about financial conditions need to tighten. Bill Dudley, the former Fed vice chair, New York Fed president and vice chair of the FOMC, he's talked about the financial conditions need to tighten. Obviously, that means stocks and bonds need to reprice. I see financial conditions per the Goldman Sachs Financial Conditions Index back at 2000 levels. So we're not really tight at all. We're just tighter than the past 2 years, which were historically easy. And then the other thing is the S&P 500 market cap to GDP. It started the year at 175% of GDP. We're down to 140% of GDP. But in the 2000 bubble peak, we were 120% of GDP. So there's still a long way to go before we find some stability. And with all the uncertainty just on the headline risk out there, I wouldn't take the chance right now. I'd be more cautious and focus on value names that have more attractive valuations at this point in time.
Well, are you going to be in cash or in something wicked defensive? I mean, the heart of the matter is, do you go to cash?
Well, because I tend to be more cautious, I would have more. I would definitely have more cash on hand. For investors who have to be invested, like I said, I see this as 2000 and 2002. Over the past 15 years, the Russell 1000 value has underperformed the Russell 1000 growth by about 65%. Value's outperforming by about 18% this year. 2000 and 2002 value outperformed by 120%. So that's how I would look at it. If you need to be invested in value.
Michael O'Rourke, thank you so much for joining today with Jones Trading as well. What I found really important there, and this is away from what I do or what I feel about, is the liquidity study and the volume study.
Yeah.
Because I'm guilty of this. I don't do enough chat on the volume belief of the street. I don't buy it. But Michael O'Rourke does, and it's important he brings that up, of the dearth of volume right now.
The thin volumes typically lead to low conviction trading, and that's when you get some incredible swings. And I think that people looking to that, whether it's in stocks or bonds, you see that kind of activity. I find it interesting that you ask him about cash and that you have a triple leverage all cash, considering your optimism on corporations
that's
to
my
adapt.
own story. I mean, I look at the choices I've had to make over the years, and when you lose money 10 years in a row, you end up with a triple leverage all cash fund. But these, there's 4 ways to go here. This is important. I own stocks, I go to cash. I'm short, I go to cash. There's 2 other ways. I'm in cash, I go long. I'm in cash, I go short. This isn't as easy as people think.
He's in triple leveraged all Prada sneakers. That's what he's in. That's all I can say. They're pretty awesome.
We're styling here in Davos.
Absolutely.
Today.
Right now, I got to say, clawing back some of the losses a little bit. S&P futures down 1% with that euro. Stronger versus the dollar, but losing a little bit of momentum. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. ECB President Christine Lagarde says the central bank won't be rushed into withdrawing monetary stimulus while it fights inflation. Lagarde spoke to Bloomberg in an exclusive interview in Davos. She said there's no need to panic. Bank of France Governor Francois Villeroy de Gallo echoed Lagarde to insist there is no consensus for a half-point interest rate hike. In Russia, opposition leader Alexei Navalny has lost his appeal against a new 9-year prison sentence. He'll be transferred to a high-security prison that supporters say is aimed at isolating Vladimir Putin's top critic even further. Navalny was convicted in March of fraud and contempt of court. Tesla is quarantining thousands of workers in China to make sure they're free of coronavirus. It's part of a large-scale plan by the electric car maker to ramp up production at its plant in Shanghai after weeks of lockdown. The workers are being housed in unused factories and an old military camp. Bloomberg's learned that Dexcom is in talks to buy Insulet in a deal that would create a giant in diabetes devices. An agreement could be reached in the coming weeks. Insulet had a market cap of $16.1 billion at Monday's close. Walmart and its partner DroneUp plan to expand their drone delivery hubs to 6 states by the end of the year. Deliveries will cost $3.99 and orders can weigh up to 10 pounds. Still, there are big regulatory hurdles. So far, the FAA hasn't written rules around allowing drone flights beyond the sight of human operators on the ground. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Newport Harcourts has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes, have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Soaring energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
There are headwinds, absolutely. There are many downside risks, but I think to say that at this point globally, the global economy, that there is a recession, I think that's a bit premature. We're seeing interest rates going up in all the major economies, and it's changing quite rapidly about how much of an interest rate hike will happen and how quickly.
The span of the International Monetary Fund, from the great Michael Musa and Rudy Dornbush over to the economics of Gita Gopinath. She was the chief economist for the IMF, and of course, worldwide news here a number of months ago, is first deputy managing director of the IMF. Thrilled that I'll be doing a panel with her tomorrow. Lisa, the panels are a big deal, and they're almost calmer and more, they seem more normal this year because there is not the super crush of people trying to get in.
Yeah, it's less crowded, let's just say that. And honestly, a lot of people talk about the more intimate nature, read less crowded, as being a bit productive because you have people who actually are here to work.
A panel that would be widely attended if they had it, I'm making this up, but if they had this panel at the meetings of the World Economic Forum, it would be attended. Is this 1998? Joining us now, Damien Sassower, Chief Emerging Market Credit Strategist for Bloomberg Intelligence. Damien, this is a hugely international Davos because the Americans, maybe the people from the United Kingdom, in less attendance. What is the state of EM finance as they come to Davos?
Well, I think the state of EM finance, quite frankly, Tom, is that you have a tale of two stories. You have countries like Brazil that were early on in the cycle that tightened aggressively, and now you're starting to see inflation roll over, and the markets are rewarding Brazil, the real, the front end of the curve, for being early and for getting inflation under control. And then you have Asia on the other hand. You know, Indonesia, they failed to move this morning. Even though you saw the Philippines come off the reservation last week, you saw India as well, Malaysia as well. You know, and the inflation impulse in Asia just isn't nearly as strong. So yes, while you can finance less expensively in Asia, you know, is demand really there in an inflationary environment? That remains to be seen.
Damien, what a great honor to speak an annual visit with Ricardo Hausman of Harvard. And Damien, you read everything he and Eichengreen Green have read on Original Sin. In the Damien Sassower space, can you get business done in your own currency, or do you have to go to more dominant currencies like the dollar?
Well, Tom, that's a great question. And the fact of the matter is, I think you have no choice but to fund in your local currency because you really can't fund in dollars, especially the low-quality emerging market credits that lie out along the frontier, you know? I mean, double Bs, you know, even, you know, you're seeing Colombia and Serbia. You know, I just looked at credit default swap implied probability of default, you know, this morning. And, you know, levels are surging through the roof. You know, CDS spreads are incredibly wide. The problem, Tom, is they could still go wider. You know, we've seen them wider. We're only back to taper tantrum 2013 levels. And so, you know, that's a risk. And so, look, you're not seeing a lot of people accessing the U.S. capital markets, at least not in the EM space. And I think the same goes for high yield, unless you want to pay 10.5%, you know, coupons to your creditors.
So much of the underperformance in emerging markets so far of that, how much can that support an economy that's flat on its back because people can't get out to spend?
Yeah, no, I mean, that is the question, Lisa. You've hit the nail on the head. 3 words for you: credit risk mitigation warrants. Actually, that's 4 words. No, I'm kidding. And that doesn't really even matter because you're right. The demand for housing, for equities locally from locals in China is incredibly weak. And the wealth destruction is unlike anything. It's unprecedented. We've not seen anything like it. So what's it going to take to get Chinese demand back on track? It's going to take massive fiscal stimulus. It's going to be an end to COVID zero, and it's going to take some monetary cuts on the back of that as well. And, you know, we're really just not there yet. So, you know, so long as China remains offline, emerging markets will I think will as well.
Damien, a delicate question for you, but one of the discussions underpinning a lot of talks of emerging markets credit and the potential risk of defaults is that a lot of the obligations stem from China. China is one of the biggest lenders to the emerging markets complex, although it is not transparent. How much of a risk is it that weakness in China will lead to a less benevolent kind of mood in terms of debt forgiveness?
Oh, that's an interesting one. You know, we've given some thought to that, you know, and the fact of the matter is China has been, you know, they've been willing to work with other countries on that front, you know, more so certainly than the U.S. creditors, quite frankly. But yeah, you're absolutely right. We are smelling the sea of change there, Lisa. You know, they have a very weak return on investment for their, you know, infrastructure investments abroad. I mean, just look at Sri Lanka, you know. So, I mean, my point to you is exactly that. Look at Angola, you know, so how much longer will China float the boat there remains to be seen, but my guess is they have bigger problems domestically, and that's going to take their attention away from the broader emerging market landscape.
I mean, Damien, part of the problem here is being in Switzerland, and with all the development, we see people that trade as you do in the international space, and they've got to bury the money in Switzerland. Now, in the old days, I know you did it through UBS and Credit Suisse and all the private banks, Damien, but the idea that you picked up 48 acres in Davos, Switzerland for the Sassower lambs and goat farm, I just think, you know, that's really good, Damien, that you did that.
No, it looks beautiful there, Tom. I mean, I love the overcoat. I mean, for me, look, I'm more of a Cayman Island, Bermuda, you know, I'm more of a Caribbean safe haven, tax safe haven kind of guy. Maybe Mauritius, for example, you know, they've got a flexible tax jurisdiction there. So, yeah, no, I mean, I hear you, you know, things are getting a little bit tough. Yeah, sure.
So,
the goats and the lambs have a flexible tax structure.
Can I just say, surveillance insight here, surveillance research, what's the difference between goats and sheep? Sheep are grazers. They're the ones that are going around eating the grass.
Only you.
So it's the foragers. It's the way that you forage.
Forager?
Yeah, it's the way that you forage is really the difference.
Grazing?
Versus, yes, that's right. Yes.
Damien, she never ceases to amaze me. I don't know.
I think I rendered him speechless.
Damien, we'll see you on the floor.
My jaw is agape, Tom.
Damien Sassower of the Sassower Goats and Lamb Limited. That's what you do in Switzerland when you're really trying to hide the millions. It's LTD.
Yeah,
I have no idea why that is as well. Seriously, there are some really important things going on in EM. Damien mentioned the Philippines with their election, much more turmoil out there, including Mr. Orban making serious headlines in Hungary this morning his reticence for gas and oil limitations. Stay with us. The World Economic Forum meetings in Davos. This is Bloomberg.
Welcome back to another special Roland Garros update for Bloomberg TV and Radio from Tennis Channel. I'm Jamie Maggio. A major upset in the women's draw on day 2 in Paris. Amanda Anisimova clinched the biggest win of her career at the Slams after she took out 4-time major champ Naomi Osaka. The American closing out the Japanese superstar 6-4 in the second set.
It's a tough match. Going into it, I was trying to treat it as like any other first round, but you could definitely feel the nerves in the match. So I'm just happy with, how I was able to play and manage it.
On the men's side, the king of clay eased into the second round. Rafael Nadal dispatched Aussie Jordan Thompson in straight sets to move on. The Spaniard's looking for a record 14th crown in the City of Light and to extend his lead at the top of the all-time list at the majors. Don't forget, Tennis Channel's daily live coverage from Paris hits the air at 5 a.m. Eastern. I'm Jamie Maggio.
the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. Earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
you're still seeing people just very apprehensive to invest.
There's been carnage in growth, public growth stocks.
If the Fed continues to tighten to try to reduce demand to get inflation under control, I would expect to see that flow through into discounted growth.
There's a lot of negative things going around in the world away from the U.S. that could really drag the U.S. market down.
Discontent has become global. We've had globalization of global discontent.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning from a foggy Davos, where the conversations are equally foggy as we count to an uncertain future. This is Bloomberg Surveillance on Bloomberg Television and Bloomberg Radio. Tom Keene and Lisa Abramowitz here. Jonathan Farrow is off. We are at the World Economic Forum meetings that have been fascinating with a new tone, Tom, really focused on how to address some of the imminent crises, these sequential crises that have left us with an economy unrecognizable in modern history.
The crises are plural, but the underpinning we have not talked enough about, which is the war in Ukraine. The war in Ukraine is evident in every conversation, in every tone here. You mentioned earlier Russia House, where I've been many times, is now Russia War Crimes House. So it is visible, but it's underpinning to all these other issues.
Yeah, and we've seen those issues being underpinned in a lot of earnings calls. The latest being Snap, which Tom likes to call Snap-on Tools. It is also known as a social media company. The CEO coming out and talking about how the macroeconomic backdrop has deteriorated rapidly. That's sending tech stocks lower. How much does this just become an idiosyncratic move? Some of the noise that you talk about it.
I don't agree. To me, Lisa, it's 2 days of a move off of a horrific 7 weeks.
It has
been
more
data.
We all need more data, but we are looking right now, 30 minutes away from the open in New York City, at markets that are finding more gloom than optimism just at this moment after trying to retrace some of the losses of the past 7 weeks. Yesterday, we are seeing futures lower by 1% on the S&P at 39.31. Euro strength, I think, is really notable with dollar weakness a little bit here. I think that's interesting, and I think that what we're seeing is a feeling of optimism that the ECB will tighten and that perhaps the Fed will not tighten as much, with some recent comments about possibly pausing in September. That from Raphael Bostic of the Atlanta Fed. But Tom, definitely a moment of uncertainty with lots of executives looking for off-the-record conversations with policymakers and others to gauge how to position.
Yeah, well, how to position is we've seen a flip here with euro yen finally showing euro strength, as Lisa mentions, and that's been a sea change, I'd say, in the last 2 hours. Right now, to begin our conversation, we'll move very rapidly here. Peter Ciani joins us, Director of Research at Axionic Capital. Peter, how unusual are these markets? Is there a normal back and forth, a dynamic to them, or is it something very different than what you've seen before?
Well, good morning, Tom and Lisa. I want to say I'm really enjoying the show this morning, and the sheep metaphors have been particularly enjoyable within the context of Davos. It's interesting, Tom. I'm not old enough to have lived through the 1970s. The analog that we've been discussing really since late last year was the prospects for some hybrid analog between the 1970s and 2018. 2018 at the end of the year, obviously, into the end of the year, we had a market sell-off that was catalyzed mostly by quantitative tightening. And of course, the 1970s saw similar margin dynamics to what we're seeing right now. So I think the dynamic is quite different. And I think we're really, the biggest point here, I think, is that we've seen the end of a 40-plus secular downtrend in interest rates, which has come to an end. And by the way, it had to end with or without inflation in the U.S. at zero. But clearly, inflation has now forced the Fed into an almost unwinnable situation where it has to hike.
Peter, there's a lot in there to unpack. I want to hone in on this idea of margin pressures. Have we just seen the beginning of margin compression, or are we basically seeing the gist of it as we readjust to a new inflation?
No, I think it is just the beginning. You know, we started writing about it at the end of last year when we observed the sort of historical relationship between PPI and CPI. And when PPI, which can be considered something of a proxy of input costs, exceeds CPI by the amount that it began to last year, even before the invasion of Ukraine by Russia, margin compression, especially for smaller companies with less pricing power, tended to occur historically with about a quarter lag. I think this is just the beginning. I think we're seeing it in earnings reports this quarter. And frankly, if you looked closely enough at small caps towards the end of last year, we saw it begin then. And I think it's going to accelerate into the middle of the year.
Peter, before we let you go, and I'm sorry that we don't have more time with you, I do want to get your view on what we have been speaking to people about, the bubble bursting within certain tech names. And I think about what's going on with Snap and, frankly, the social media complex today in general. Is this still going on, or have we mostly seen it basically wash out?
Well, it's interesting because now the consensus has shifted as quickly as it had towards what I think is a very bearish positioning, and we can see that in options markets when we look at negative delta within 1% of the at-the-money strike, for example. I think we're close to washed out in the near term, but I do think I'm in Mike Wilson's camp. I think we could see quite a bit more downside in equity. But I think we are set up here for a rally at a pretty important support level, with consensus now having shifted quite bearish.
Peter, thank you so much. Peter Cicchini with us with Axonic Capital this morning. This is a joy and particularly timely. David Livingstone has carved out of Macquarie and Cambridge a career across European banking. He is more informed than anyone I know in the European method of business, in the challenges to the future, assisting Jane Fraser at Citigroup, their Chief Executive Officer for Europe and Points Close. Obviously, sir, you have never seen it like this before. And we have a war in Ukraine, all the different crises. Tell us how you establish optimism for business 3 years out, given this tumultuous 2022.
I won't disagree with you, Tom, but I think we can look to the past and previous challenges. We remember the Gulf War, we remember the recession around that time, a different nature and perhaps a different scale. And if you combine that with the challenges for energy security, as well as the policy around energy transition staying on the agenda, I think we could use the same tools that we've used before, which is focusing, as companies do, policymakers, on productivity, on reform, on looking for those areas that, as you say, will be there in the 2 or 3 years' time. And so we shouldn't forget the agendas that we took into these crises while we focus on the solutions for them in the shorter term.
In the short term, we have an agenda of war, the anger of war, the sacrifice of war. On a business standpoint, it is many Citigroup clients leaving Russia, and many others as well. How will we account for this rapid exit and loss of finance in Russia?
Well, as you know, it will have and is having a very detrimental effect on the domestic economy in Russia, as intended by the sanctions. I think the challenges for the companies as they seek to manage their exits from the country is there are capital controls and there are other things in place, and they also have employees. They also have others who they need to take care of during this time, and they need banking services for that.
This is too important. Has the delay that we've seen of different companies primarily been their need to respect their employees within Russia?
I think that's part of it, yes.
Going forward, I know that your chief executive officer has talked about the likelihood of a recession in Europe and that she sees it as quite likely. How are you preparing for that?
Well, I think we prepare for it by being with our clients and seeing what they're the things that they need to do, but also by working with policymakers. I mean, you said in the earlier part of the segment, what will the ECB be doing? And I think we're looking clearly for the signals of whether inflation is going to be the primary concern of the ECB, as it seems to be with the Fed, or are they still going to keep a very accommodating stance in order to keep economic growth positive? That's been a challenge for over a decade. I think they may well change their stance this time.
But then how do you dovetail the risk appetite of lending at a moment that could be on the precipice of a downturn, at a time when interest rates are rising and shareholders are demanding profitability?
Well, lending isn't the only tool that the financial services and banking system, and one of the things that we work closely with Europeans, both at an EU and a member state level, is really on that structural reform, particularly post-Brexit, that the EU needs to go through to deepen capital markets and access for their companies, small and large, to capital and alternatives to the banking system. EU today is over-reliant on bank balance sheets. And so going through those reforms, getting more access, as well as at the same time building a domestic buy-side industry which is nascent in Europe outside of Luxembourg.
David, you read my mind there, and that the heritage of Europe is bond, note, and bill, and the bank balance sheet, as you say. Right. And that is the heritage of Citigroup back so far. Are the bond losses now a catalyst for finally Europe modeling a more Anglo-Saxon balance sheet? If we see bond prices go down, there you go, wait a minute, they're doing it better in America? I don't think they're going to say that, but it's good for TV.
I think there's the depths of the U.S. markets, all markets around the world look at with jealousy, the depths of the U.S., particularly debt markets. I don't think it needs to be that type of catalyst. I think it does need, though, to be seen as an achievable goal, and therefore it might need to come from a European level to a member state level in order to get the pace of reforms that have sadly not been present in recent past.
Where do the American banks fit in here? You have many competitors with many different strategies. We over-talk about Asia and the expansion into Asia, and we under-talk about the expansion into Europe. How do you see this, and particularly coming from Australia and with Credit Suisse for years, how do you see American banks prospering and competing in Europe?
Well, we see ourselves firstly as a global bank, and in this region as a European bank. I mean, we have presence in 24 European markets.
But the rate of change?
Well, the rate of change is something we're used to, and it's not something which surprises them. I think one of the things I challenge our teams is to make sure that we are as ambitious as possible on behalf of our clients, to make sure that whatever strategies they're developing, whether they are constraining in the face of economic contraction or whether they're expansionary, that we're there to serve them and to make sure that we've got the products and services they need.
What's the mode right now among your clients?
Cautious. But as I said earlier, I think if they're falling back on the things that they know, the strategies that they're pursuing, we mustn't forget there's still enormous liquidity in the world. So there isn't a liquidity problem. There's a growth and potentially earnings problem.
What about the businesses in terms of how much they're able to pass along the price increases they're seeing in the base input costs? I mean, honestly, we're talking to Tony Capuano of Marriott, and he's saying pricing power is absolutely paramount, but it's also evident in the strength of the consumer in the U.S. How is that different in Europe?
I think it's untested in the way that, I mean, in the US, I mean, inflation hasn't been present like this for 4 decades. Similarly, certainly in Western Europe, it's the same. We'll have to see how pricing power, translates. I think the distinction in Europe, of course, is energy input volatility, gas prices much higher here, and if there's further interruption, I think that's going to have very significant inflationary effects, but that's going to pass on to the consumer very quickly.
When you picked up the pieces out of 2007-8, Citigroup had the wisdom to go looking for Willem Bouter as chief economist. He provided a terrific theoretical foundation for Citigroup research, and I would suggest Citigroup business as well. Bouter goes back to economic fundamentals, which is the stereotype that Europe underperforms America on a real GDP basis. You know the story. You've lived the story as well. Tell us about the new Europe coming out of these crises that will compete.
So Europe, we must remember, competes globally, not just within Europe. And the capabilities, the sectors, the sophistication of corporate Europe is very, very high and can compete anywhere. So we must not just get locked into what's European growth, but what's global growth and how are European companies participating in it. So I'm more optimistic than perhaps Willem's core thesis that he said.
That's where I want to get. It's the surveillance break exclusive. Livingstone, more optimistic than Bouter.
Well,
see that? There's the inside baseball.
I want to break exclusive. January or May? Which do you think is better for Davos?
January.
Really?
Why?
An outlier opinion. Why?
The heritage of it. It should say traditional. It should stay there. And
there's an opinion.
All right, David Livingstone.
Jane Fraser probably said May. And
yeah, exactly. They'll hear about the difference of opinion. David Livingstone of Citigroup, thank you so much for being with us. We want to dig into the specific stocks that are moving here with about 15 minutes to the opening bell. Yeah, that's right. Abigail Doolittle evidently is going to get schooled on how it's Snap-on tools from Tom. Abigail, what are you looking at?
Well, we will be taking a look at Snap in a moment, and we do, of course, have U.S. futures sharply lower, down more than 1% on that social media weakness. First, though, let's take a look at what's working and fitting to the volatility that we are seeing this year and in recent days in particular. One stock that had been soaring earlier, Best Buy, is now down about 0.8%. Now, the good news is they put up a better than feared sales for the recent quarter. Inventories maintained, but the forecast a little bit weaker, so that's probably what's weighing on shares. AutoZone, they put up a very strong quarter relative to beating both top and bottom line estimates against headwinds. Analysts are saying inventories, though, up almost 14%. Maybe the used car surge that we saw out of the pandemic is peaking. Zoom, speaking of the pandemic, a darling, it seems as though it's not a one-hit wonder. They put up 19% sales beat. They also had a solid outlook. It seems as though there's some user growth there. And then Albemarle earlier, that stock, that chemical stock, company stock had been sharply higher, now up just slightly. Massive beat, a 200% beat on the bottom line, a big number too, $2.68 on lithium demand for EV batteries. Now, let's take a look at what's not working, what's really dragging on futures and the tone. And that, of course, is Snap. Yesterday after the bell, down 35%, heading to a record low day, record plunge after they pre-announced the downside for the current quarter relative to profits, all about the macroeconomic inflation, rising interest costs, the Ukraine war, saying that it's really eating into the demand for ad budgets. Now, this is super interesting because you can see it's weighing on these other social media companies too. Pinterest also down sharply, down 18%. Twitter, as though it didn't have enough problems of its own, down 3.6%. And then Facebook down sharply, and that's a big weight to the major averages. Of course, Facebook back in February talking about the weakness relative to users. Now it's double whammy. It's also corporations in terms of advertising spending. So lots of issues to deal with in this macroeconomic, again, creating a softer tone into the open, Tom.
Abigail, thank you so much. Greatly appreciated in New York. Again, on radio and television, the meetings of the World Economic Forum here at Davos, really most interesting. And we continue now with a global view and the global timeline. And we do that with Matthew Hornbach, Global Head of Macro Strategy at Morgan Stanley. What really interested me today, Matt, about your note and your team's note is everything is about guessing out, extending out. You mentioned Lagarde in the comments of shifting from negative rates as well. How uncertain is the timeline right now, particularly to Q3 and Q4?
Tom, thanks for having me on. Gosh, Q3 and Q4 would seem like years away from today. I think there's a lot of certainty about what these central banks are going to deliver over the next couple of meetings. You know, the ECB, the Fed, we're looking at 25 bips from the ECB in June, 50 bips from the Fed in June. You know, those meetings seem like near certainties. But you're right, it's Q3, Q4. That's where things start to open up a little bit. We are expecting the Fed and the ECB to continue to hike. We've got the ECB going again in September and the Fed as well. But, you know, once we move into the fourth quarter, I think that's where the uncertainty really expands. And that's where you could see central banks doing something slightly different, perhaps.
Matt, you can't catch a bottom. Your Michael Wilson was with us earlier, and I thought was really articulate about the choice set investors have now. What is the key item that you use in trying to find an equity bottom, an equity opportunity?
Well, I mean, Tom, for me, one of the things that I would be looking closely at would be real yields in the United States. We saw real yields jump dramatically in the first quarter of the year and through the month of April and into May. I think if we get some stability in real yields in the U.S., particularly longer maturity real yields, so let's say look at the 10-year sector of the term structure, then, you know, that to me would be a prerequisite for some stability in broader risky asset classes like the equity market.
Matt, we're looking at a bull case right now that a lot of people are putting out there of the Fed possibly pausing in September with their rate hikes and reassessing and maybe taking a slower pace than is currently priced in. Is the reaction in the long end stability in that scenario, or quite the opposite? Could you see longer-term yields sell off dramatically, yields surge as a result of the Fed moving away from a really aggressive approach?
Lisa, you know, that's going to depend a lot on the situation we're facing with inflation at that point in time. If inflation continues to bother investors, if the news media continue to cover inflation like they have been over the past 12 months, then you might very well see the long end of the yield curve protest any kind of a pause from central banks. However, you could also be faced with a situation where inflation is disappointing or surprising to the downside in terms of how the data is coming in. And if that's what we end up seeing, then a pause from central banks is going to feel very appropriate to markets. And so you could actually see longer term treasury yields settle in even more than what we're expecting at this point.
Okay, so given this wide band of outcomes, where's your conviction right now?
Well, we've been telling investors, Lisa, is to prepare for a range trade in government bond yields. Now, range trades can be boring or they can offer opportunity. And one of the opportunities we see in the rates complex these days is to favor U.S. duration over Europe duration. So we think that bond yields in Europe could continue to move higher, while bond yields in the U.S. can stabilize here. So we do think that there's some opportunity for relative value, but generally speaking, we're looking for yields to consolidate the losses that they've experienced.
Matt, that's great. That's very sophisticated, and I'm sure people are taking notes on radio and television. The problem is I've got a bond or a bond portfolio or an ETF, and I'm down 10 or 12%. And I'm not going to recover if I'm mere mortal with a duration trade across the Atlantic. How do you recover if you're that far south in bonds?
Tom, unfortunately, we're dealing with fixed income products, and time is the best friend for a fixed income investor. Time. It's going to take time, Tom.
We've never seen it, Matt. We have never seen the time we confront forward. I mean, it's just, I look at the Lehman, the Bloomberg Total Return Aggregate Index, Matthew Hornbach, and it's just jaw-dropping how time is our new friend. And it's not 1 or 2 years, is it?
No, it's going to take a while, I think, unless you really see inflation surprise investors to the downside over the next 6 to 12 months. I mean, look, it's possible, right? We just came through a period where inflation surprised everyone to the upside. To sit here and suggest that there is no chance of downside surprises over the next 6 to 12 months just wouldn't be facing reality. I think there is certainly a chance.
Matt, how far along in the credit repricing are we? Because initially in the year, it really was a rate repricing. And then the past couple of weeks, we've seen more of a credit tightening kind of event. Are we all the way there, or is there more to go?
Well, there's probably a bit more to go, I think, in line with the view of our chief U.S. equity strategist, Mike Wilson, that equities have more downside. I would be surprised if you didn't see some further widening in credit. But, again, we're a lot closer to the finish line than we were at the beginning of the year. And that's one of the reasons why we think that you could see some stability in the interest rate complex. So, again, look at real yields. That's going to be really important for the outlook for risky assets, I think.
Matt, how do you get your clients inspired? When you say a range-bound market, you can wait for 5 years and you can get some income. I mean, where is the inspiration from bonds that traditionally, over the past decade at least, has been incredibly inspirational with the rally?
Yeah, well, look, there's more than one way to skin a cat in the fixed income marketplace. And I think the levels of yield that we're seeing today are obviously more attractive than they were at the beginning of the year. The levels of volatility in the marketplace up until this point have been very high. And so I think ultimately a tried and true strategy of selling a volatility over time, that's a way where people can add income to a portfolio when they've experienced losses so far year to date. So I think, taking advantage of the higher levels of implied volatility is a good way of trying to monetize the premiums that you see in markets today.
Matthew Hornbach of Morgan Stanley, thank you so much for that. It's interesting to see how people retrace and try to recast bonds after the volatility that we've seen.
Matt Hornbach, thank you so much. I can't tell you, Lisa, how this pro conversation with a legit, sophisticated pro harkens back to the late 70s. The echo of the phrases, the echo of rationalizing bond price decline, and, in the game of how do you recover? how do you begin to make it back? It's very articulate, but we haven't heard this in years.
Yeah, this is a new terrain with respect to inflation
I like
and
that.
how you move around and position for it. I do wonder some of the sovereign wealth funds, because there are a lot of them here.
This is important.
How they move the needle, given that they have such massive holdings and they have such massive losses in bonds and stocks. How do you then move the dial back the other way and fill that hole?
We're getting out front on this, folks. This is a June, July, even into early September story here about what serious old money's doing with these losses that they've seen in bonds. The other thing we're dealing with, where the fog is coming in, now I've just triangulated the fog, and over here, to help you with a surveillance map, on radio the map really works, is Austria's over there, Italy's behind us, hi Lake Como, hi Davide Serra, and the fog is moving from Austria to Italy.
Thank you,
right
Tom.
through our tent.
We could talk about that with
Look,
Michael Purvis.
I can't see the damn lambs. Are the lambs and the goats okay?
Sheep. They're sheep. Michael Purvis will weigh in. Chief Executive Officer coming up next of Talbot and Capital. This is Bloomberg.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
For the World Economic Forum in Davos, Switzerland. This is a Bloomberg Surveillance Live on Bloomberg Television and Bloomberg Radio, alongside Tom Keene here in a very foggy Davos, the Davos fog.
Very different. I mean, you know, we've had some hellacious snowstorms over the year. They're clapping here. They're clapping because we're using here, when we leave the New York Stock Exchange and the movement's down, Lisa's is ensconced in our official wool Swiss blanket. It's gotten that cold. It's very good. That's what we use the lambs and the goats. Yeah. Is it goat wool or lamb wool?
It's sheep wool. Okay. No, but honestly, we are seeing the sell-off deepen as we sit here with the fog deepening in the valley, and we do want to take a look at some of those moves. Abigail Doolittle is looking at the specific stocks as the bell is rung in New York City for the New York Stock Exchange. Abigail, we know there's been a big focus on tech. What are we seeing?
Yeah, absolutely, Lisa. We do have this bearish day with the indexes down more than 1%. And it has everything to do with Snap, which is interesting because, of course, is not a member of the S&P 500 or the NASDAQ 100. But you can see it. It's absolutely plunging, down 36% on pace for its worst day ever. This, of course, after yesterday, the company pre-announced the downside relative to the profit outlook for the current quarter, saying that the macroeconomic picture has worsened so much. And remember, just a month ago in April, they put up a good quarter. So it's a tremendously fast deterioration relative to inflation, interest costs, the Ukraine war. So that company's outlook and tone really weighing on other social media companies. Meta Platforms down 8.1%. Alphabet is down nearly 7%. And Apple, having nothing to do with social media, well, in a way, they don't. But relative to their phones, lots of social media can be put on there, down 1.1%. The point here is this is 20% of the NASDAQ 100. So that negative outlook and commentary out of Snap really weighing on the markets relative to tech. As for what is working, there is a bright spot. Interestingly enough, it's specialty retail. Take a look at Best Buy up 1.9%. They put up sales that beat better than feared. Inventories are okay. They trimmed the outlook, but investors seem to be looking past that right now. The CEO did say that they're seeing signs of softer demand, but not a recession. So some comfort there. Petco, people are still spending on their pets, myself included, up 6.1%. No. Yes, I do have a cat, Jojo, who I have to pamper often, so I'm at Petco, and a part of that beat, and they also held the outlook. Ralph Lauren earlier had been higher. They beat and they raised the dividend, but now the stock is down. We'll, of course, be digging into that. And then finally, we do have AutoZone up about 2%, a very solid beat. Some analysts saying it's impressive given the headwinds. Inventories up a little bit, suggesting that maybe the pandemic used car surge is going to peak. But overall, here are some of the winners. Right. But with the big heavyweight techs down, a tough day so far. Jojo.
Abigail Doolittle, thank you so much. Greatly appreciate it. Right now, our most important equity conversation of the day, and that is because we're hearing so much caution, so much tentativeness in the market. Michael Purvis flat out disagrees. Chief Executive Officer, founder of Tallback and Capital Advisors, and far more expert on the Pacific Rim dynamics. We'll do that in a moment. Michael, what does the Bear Crew get wrong?
Well, it's Tom. I'm not categorically bullish here, but by any stretch, I think we're dealing with a lot of two-way volatility, and right now, in the very near term, when you consider that valuation has improved dramatically. We dropped more than half a PE point just last week. The equity risk premium is much better shape. Positioning, as many people commented on, is very, very, very bearish there. And that sort of creates sort of sets the table for some pretty vicious rallies here. That doesn't, if we get up to 4,400 here, which I wouldn't be surprised over the next few weeks, that doesn't mean, that's the end of, bearish activity in the broader market. I think there's cross-asset volatility is going to be elevated for some time, and that's going to keep people from sort of buying the dips on a committed basis the way they had been in the past.
Michael Purvis, are the traditional tools useful now? You've been doing this for years. You and I have seen 8 colors of bear markets. Do the traditional metrics work?
Look, I think this is one of the most unusual cycles we've had. We've never seen, the sort of collision of a pandemic, once in a century pandemic, with our first, what I call big war in decades, and accompanied by extreme monetary and fiscal policy concurrence, right? And layer on top of that, the rise in ESG investing and ESG policies over the last 2.5, 3 years that has, it's really inherently inflationary, right? So there's been, it's a very, very unusual cycle. And I think there's a lot of good things happening. There's a lot of bad things happening. That's why I think we're sort of looking at a very sort of confusing cycle for some period of time. And I think that's going to create a lot of vicious price activity. It's a little bit like 2011, where you never really got into a bull trend and you never really got into a bear trend, but the VIX was above 30 for, I think, more than 40% of the trading days of that year.
So, Michael, when you're talking about vicious price moves, let's go to the one that's happening right now. Snap down, I believe, at 36%, the biggest drop on record for this share. And I am wondering the scope of some of these moves on cautious outlooks by the CEOs. What do you make of them? What do you say about the liquidity or just the lack of conviction that leads to such a dramatic drop, a third of the value of a company erased overnight?
There's no question that market structure is in a very different place than it has been in some time. There's certainly just liquidity is not there, and I think that's true across a wide spectrum of traded assets. But there's another function here, another thing as well, which is that if you look at the growth of cash volumes over the last 15, 20 years, and then you look at the growth of options, on those same securities, those same equities. Option growth has been growing at 8 or 9% a year, every year. Cash volumes are flat. And that's a recipe for sort of further aggravated price moves, which means interpreting Snap and, whatever else have you, whether it be good or bad, is, just comes with a much higher noise to signal ratio.
Well, hold on a second, Michael, because this is important. The options trading that you're talking about, is that institutional or is that the retail traders on Robinhood that a lot of people were talking about?
It's really both. I mean, I think, on the retail side, it may be more relegated to single stocks. But, if you look at the rise of, a lot of short volatility products, now that hasn't been in fashion over the last, really since COVID, right there. But that, there's just a lot of options from the institutional side, a lot of products that use, either are selling or buying options. And that just makes things, it's not an indictment of the markets when you see these kinds of price moves, nor is it an endorsement the other way. It just creates a lot of intraday and day-to-day volatility.
Michael, this is a really important observation that you make here. And it goes down to the implied leverage of options and futures. And we can navel gaze all day on that. Let's not. But is it almost a hidden leverage within the system that so many people are in derivative strategies versus the cash market?
Yeah, I mean, again, I think it comes down to, a case-specific, it's very specific to the strategy there. But yes, I mean, I think there is some leverage. But, if you're long a call on Apple and it expires worthless, that's a very different thing than being short a put on Apple and not having it go the wrong way. And so I think you have to, really get granular into what you're long, what option you're long, and what option you're short there. But there's no question that until, without cash volumes really climbing and making the market steeper there, you're going to have this condition where you're just going to have a lot of these crazy price moves.
Michael, I've got to ask you about your work, 2, 3, 4 years ago, where you absolutely nailed ADXY, the Pacific Rim Currency Index, ex-Japan. Give us a call here, please, on renminbi with the pullback we've seen there, weaker yuan, but also the sudden move in yen weakness. What are your thoughts?
Well, Tom, if I may, what I'd love to just sort of focus on quickly for a second is how the U.S. break-even markets are shifting towards China there. It's related to your question, but look, if you look at break-evens across the 2s, 5s, 10s, and 30s, they have gone back to pre-Ukraine invasion levels, right? Oil has not. Oil has gone higher. What has gone lower is copper. What has gone lower is Chinese economic data there. And I think with when we're talking about this sort of reflattening of the break-even curves and this treasury bid, there's this calm in the treasury market. It comes to the China story. It's interesting because Russia was sort of, invasion was, big new incremental supply shock. With China, if this narrative's correct, that they're really sort of tracing the Chinese lockdowns, that begs a lot of questions, because if China unlocks down and you do see an acceleration of growth there, then you're going to see arguably some new pressure, new inflationary pressures being brought in. Chinese inflation is 600 basis points beneath U.S. inflation right now. That may not stay that way, right? We may see a sort of turning. But again, the issue is complicated because if China reboots, you may see some goods inflation continuing to moderate there, right? If China Inc. is back in business, but at the same time, you have the second largest economy putting upward pressure there, and then if that will ricochet into Europe in both good and maybe some bad ways. So I think it's a really complex story there and very important for the U.S. Treasury discussion.
Michael Purvis of Talbot and Capital Advisors. We have to leave it there. Thank you so much. I do want to just note that we are seeing the NASDAQ break down a bit further, and you are seeing that relationship, the traditional one between bonds and stocks, reassert itself, because you're seeing bond yields come in pretty much more significantly, price up, yield down, this bid to bonds accelerating with a flight to havens.
Well, there's some moves here. We've had 2 days of quiet, and all of a sudden the 2 days of quiet is over.
Yeah,
effective immediately. I got a 2.25% NASDAQ move down, and the yield space is really showing us the change here from, I'm going to call it Sunday Asia time, early Monday Asia time, with a 10-year yield now 7 basis points.
Yeah.
278.
Yeah, we can touch on that with Kathy Jones coming up next of the Schwab Center for Financial Research. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Strategists at Goldman Sachs and Bank of America see more stock losses before the Fed signals an end to monetary tightening. BofA writes that the Fed has offered no help to risk assets and appears far from stepping in. Goldman says the sell-off will reach a bottom once the Fed signals an end to tightening, and that may not happen until a recession is apparent. Europe's two largest economies kept growing in May. Germany and France benefited from a sustained rebound in services that offset fallout from Russia's invasion of Ukraine. S&P Global gives the credit to the loosening of COVID restrictions in both of those countries. Meanwhile, manufacturing was weighed down by rising prices and those supply chain problems. Shares of Abercrombie & Fitch plunged in early trading. The retailer reported a surprise fiscal first quarter loss and lowered its annual outlook. The results show how rising prices are eating into companies' profits. Freight and raw materials costs cut into Abercrombie's margins. And Best Buy offered some relief to investors in that retail sector. The consumer electronics chain posted first quarter revenue that beat estimates, but it couldn't avoid joining the list of retailers cutting outlooks for the year. Best Buy cited the worsening economic backdrop. And Walmart and its partner DroneUp plan to expand their drone delivery hubs to 6 states by the end of the year. Deliveries will cost $3.99 and orders can weigh up to 10 pounds. Still, there are big regulatory hurdles. So far, the FAA hasn't written rules allowing drone flights beyond the sight of human operators on the ground. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani.
His company, Reliance, has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg. Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
We have some breaking data as we broadcast here from Davos, Switzerland. We get PMI information from the United States, from S&P Global. Let's get to Abigail Doolittle since it is moving the markets quite a bit. Abigail.
Well, Lisa, we do have solid misses here for many of these PMI numbers. So let's break it down because there are, of course, three indexes to take a look at. The manufacturing index is the smallest miss, the actual coming in at 57.5 versus the survey at 57.7. Interesting, though, the services, because there are so many folks on the street saying that some of the misses that we've seen in retail is going towards services as folks want to get out of the house and do things after the pandemic. That missed, coming in at 53.5 versus the survey at 55.2. The composite overall came in at 53.8 versus the survey at 55.7. And importantly, a year ago, that composite index at 68.7, so dropping by 15 full points over the last year. But importantly, Tom and Lisa, as you know, above 50 indicates that there's expansion. Below 50 is a contraction. So right now, all of these PMI indexes for the U.S. for the month of May, the preliminary reading, in expansion, but going in the wrong direction. The trend is certainly down.
Abigail, thank you so much. On radio and television, it's simple. The line moves down. If you're looking at a 10-year yield on a yield basis, we've come in 7-8 basis points. These are abrupt moves. And as Lisa mentioned, NASDAQ, let me get it up. This is the cheat that we do, folks. This is revolutionized finance. The Bloomberg terminal on your cell phone, which is how we do things here. 2.7% on the NASDAQ, down 319 points. Dow points 159. SPX was a negative 45, 47, now down negative 54. Perfect time to speak to Kathy Jones, Chief Fixed Income Strategist at Schwab Center for Financial Research. Kathy, do you have a key level where if we have lower yield on the 10-year, where we go, oops, in terms of the belief in higher yields?
Oh, yeah. I think if we go below 2.5% on the 10-year, that's going to signal to us that, the expectation for significantly higher yields down the road has been wrong. We've been in the camp that has expected that the Fed will not tighten as much as they've indicated or as much as the market is built in, that we will see slower growth and that will mitigate their need to tighten the policy as much as, I say, the 3% or so that the market's built in. I think what you're seeing at the long end here is I'm concerned about growth. As financial conditions tighten, as the Fed tightens, we're seeing those concerns about growth.
Kathy, walk through the core equation. Nominal yield, 2.7 whatever percent, less some belief of inflation, and that gives you the residual, the real yield. Which of those three numbers matters now in nominal, less the inflation guess, equaling what's left over?
Well, I think the inflation expectations component's really important. And we've seen from the break evens, from swap rates, we've seen that come down pretty dramatically. We've also seen the five-year forward come down. So the market is pricing in less, I think, less and less in the way of tightening and less in the way of inflation pressure. And, that's pretty normal. The Fed tightens, they slow the economy, they tighten financial conditions, things slow down, and eventually inflation starts to ebb.
Kathy, when you move from theory to the nuts and bolts of who's buying and who's selling, have some of the biggest buyers come back into the market, like China, like Japan, given the fact that they have really been some of the biggest swing factors here about where stability comes for bonds?
Yeah, we haven't really seen a big upshift yet because the hedging cost vis-a-vis the Japanese yen is pretty expensive still. But I do think what we're seeing is some of the institutional players, the insurance companies, the pension funds, they have bogeys to meet, they have hurdles to meet in the 5 to 6% area. And if you start looking at, say, triple B investment grade corporate bonds, north of 5%, that starts to get pretty attractive for those institutional buy and hold accounts. So we're starting to see them nibble there, and I think that will continue. Whether or not we see Japan come back, I think, is more a function of dollar-yen at this stage of the game. We haven't really sold a lot or haven't really diminished too much, but I think we need to see the dollar ebb a little bit before we'll see a big pickup in the foreign central bank demand.
Kathy, have we priced in recession?
Not quite, but I think we're getting there. Obviously, the risk is rising. We have financial conditions as tight as they were in 2018, maybe a little tighter when the Fed, eventually went too far and had to pivot back. We're starting to see, the yield curve, the 5 to 10-year yield curve is inverted. We're not yet there in terms of, 2s, 10s, or certainly 3 months, 10-year, because the Fed hasn't tightened that much. But I do think when you start to look at, say, high yield spreads, they're not at recession levels, but they're certainly at levels that people are worried about the risk of recession.
Kathy Jones, one final question here. At the beginning, I talked about a low yield, and you mentioned a 250 as being a seismic change in the belief of call. What are the consequences of now, once again, on weak economic data, seeing some difficulty, and then we get an inflation scare and we whip around and we move back up and onward through 3% on the 10-year yield? Every time we do this ballet, we lose some confidence, don't we?
Yeah, it becomes a really tough market for longer-term investors, particularly because there's so much volatility, and we've seen a lot of volatility, obviously, since late last year when the Fed pivoted. So it becomes difficult, but I don't know that an inflation print per se will send us back to 3%. I think it would have to be a worry that either we're accelerating demand too much or we're not slowing demand enough, the Fed's not acting aggressively enough. That would probably be what would trigger that move back above 3%.
Kathy Jones of the Schwab Center for Financial Research, thank you so much.
Well-timed.
Yeah, well-timed as we see bonds very much catch a bid, and in a more significant way as stocks sell off. We are seeing a bit of a retracement of yesterday's gains, or a complete retracement, I should say. And I'm trying to figure out the size and scope of an 8th weekly loss on S&P and NASDAQ. Basically, we Saw the longest streak going back to 2001 with 7 weeks, the longest streak going back to 1923 for the Dow, for those who still track it, with 8 weeks of losses. Are we poised for yet another week? Is this the churn that just churns us lower like Mike Wilson was talking about? Or is this just all over the place as we look at poor liquidity?
I haven't said this yet, and maybe it's more Pharaoh-like, but I think the lack of liquidity here is a big deal.
I agree.
I really haven't said that. And the way, when I look at the Bloomberg folks, what I see, and we've already come back a little bit, but the worst of the morning is just a lack of fluidity, if you will, within the system.
I mean, how else do you interpret a 36% decline on a corporate executive coming out and saying that things are looking a little bit worse and they're going to downgrade their expectations?
You nail it. This is really important. In a bear market, in the emotion of a bear market, you discern between profit-making companies and ones that not make profit. Snap-on tools mince money every single day. Snap technology, or is it like TikTok?
It's basically pictures that go away after a while, so it doesn't have a record in the same kind of way. I'll explain it to you in the break. Coming up on the Balance of Power on Bloomberg Television and Radio, Rob Portman, Republican of Ohio.
I'm too much on TikTok. That's all there is to it.
This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
Connection lost.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war. So the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be a ploy by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venergold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via via text message, he apparently began planning for this attack in earnest. Wienergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Wienergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people want to unpack that. And so my audience is a lot of them are younger investors who are looking to hone their skills.
Tech and write up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just attacked that video and were like, you explain things so much better than my boyfriend or my professor, or I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains